Catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Inflation is going to be getting worse before it gets better.
The Fed isn't going to make any presumptions about how the future turns out.
I think the Fed's job here is to be the steady hand and keep their eye on that medium term.
This is a new Fed, it's a new reaction function, and they are willing to let things run hot.
Everything is transitory in a long enough time frame.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It is Operation Get You to the Weekend from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market up 11 on the S&P, advancing 0.25%. The year ahead outlooks, Tom, starting to pour in for 2022, and they feature, many of them, interest rate hikes.
Right where I wanted to go, John, as the year ahead outlooks, we are on the cusp of November 15th. John, I've ordered the Greenberg smoked turkey, the little one we'll dabble at as we go into the Thanksgiving holidays. And John, all I can tell you is you're absolutely right. This is the weekend of the Great Reset for next year.
Wells Fargo going with 2 interest rate hikes at the Federal Reserve, Tom. Bank of America and Michael Harnett saying the following: we expect multiple hikes next year to correct a policy misstep. A view that they hold, Tom, but let's be clear, this debate is still incredibly divided as we look ahead to 22.
Can we announce a policy misstep? Now, I understand sell side's out there trying with a crystal ball to look at where we're going, but John, I really take issue with announcing a misstep now. We need to see more inflation data. Powell may look like a genius in January.
I'm not doing that this morning. Lisa, many other people are, including Mohamed Al-Erin. I'll catch up with him a little bit later.
Oh, you will,
Just to give you a sense of how much people have brought forward rate hikes, if you take a look at Fed funds futures, if you take a look at some of the derivatives trading, you can see that people are now pricing in 3 full rate hikes by the first few months of 2023, John. Just to give you a sense, people were talking about how outrageous it was that people were mapping out 2 rate hikes next year, let alone pricing in fully 3 in almost the same time frame.
The move on 5s, 20 basis points this week. It's yesterday, Lisa, yesterday and last week, just totally in reverse. Last week, this week, yields down last week, yields up this week in a big way through the curve, 2s, 5s, 10s, all the way out to 30s.
Which really raises a question to me also about the tapering. Right. Will the Fed have to accelerate the taper of their bond purchases each month to get to a quicker rate hike?
Looking ahead to early next year, Tom, on the bond buying program. By all means, interrupt, carry on.
John, I got a dumb question. Are we auction free on a Friday?
I think we are, Lisa, aren't we?
Good.
Yeah, we are.
Oh,
we already had that messy one on Wednesday, so thanks,
Thank you, Tom.
Tom.
We appreciate that.
Yeah,
Lisa's going to do the day ahead in just a moment, but you knew that anyway. Equity futures up 10 on the S&P, advancing 0.2%. Oh, dear me. Yields are higher, Lisa, by 2 basis points on 10s to 156.99. Euro dollar still with a 114 handle. I'll talk a little bit more about a call from Kit Juice later in the program.
Yes.
Euro dollar, Lisa, 114.50.
Very much policy divergence, and how much can that continue? In other words, how much can the Fed move ahead while they affect the rest of the world that is lagging very much behind? This has to do both with the economy. It also has to do with the progress in combating the pandemic. At 8:30 a.m., President Biden is participating in the Asia-Pacific Economic Cooperation Leaders Meeting. Curious to hear what he has to say about the zero COVID policy over in China, about the harsher crackdowns over in Singapore. How is he going to message this to try to get them to reopen their economies, get global growth going at a time when people are waiting for this to become endemic? It's not going away. 10 a.m. we get a data dump. University of Michigan November Consumer Sentiment Survey. We're watching the year ahead and the 5-year ahead inflation expectations of consumers. It is expected to rise to the highest in decades. And then we're also looking at, or more than a decade at least on the front end, but not in the long end. And then we're also going to be getting JOLTS data, the job openings. We saw the job openings actually come down in the last reading, a good sign that perhaps people are starting to fill those those roles. We're starting to see some equilibrium. Will that continue? 12:10 p.m. New York Fed President John Williams planning to speak. And really the issue that I'm curious about is how much is he going to indicate what a change at the helm of the Federal Reserve could mean for monetary policy. Also, he will be talking about inequities and whether the fiscal stimulus actually helped combat them or whether they exacerbated them, John.
Lisa, thank you. One stock I want to look at in the pre-market, Tom. I know you want a brief comment on this too. J&J to split into two companies. That coming from the company this morning. The stock positive by about 4%, just short of 170 now, Tom, at 169.62.
It is not the J&J those older perceive. What's remarkable here in this data, wonderful in the Bloomberg. I can't say enough about the DES screen to get a snapshot of a company that we think we know that we don't know. John, household, baby oil, the powder, all the rest of it, it's 17% of the company. It is amazing how they have deconsumered with their pharmaceutical and medical devices growth over the last 20 years.
And Tom, this company is still an absolute beast. What are we looking at? $400-500 billion market cap. It's going to take 18 to 24 months to split it up.
I know we've got an important conversation here, John, but I just can't say enough about how the margins fall to net income is hugely profitable.
That important conversation, Tom, starts now with Jean Bavin, the head of the Investment Institute at BlackRock. Jean, your words, what ultimately matters is not the timing of liftoff on policy rates, but the cumulative response. John, can you build on that for us?
Yeah, I mean, we're all focused on when exactly the liftoff is going to happen. And as you mentioned, like some are being brought pretty aggressively into 2022 now. I would push back on, 3 hikes in 2022 seems like extremely aggressive to us. But we might see the beginning of the hiking cycle in 2022. But ultimately, what's going to matter, what is very unusual in this cycle is that the cumulative response to this kind of inflation that we haven't seen in 30 years will be much more muted than historically. And that's going to be meaning that real rates, in our view, are remain very low for a sustained amount of time. And that's a different read-through to risk asset. I think that's a much more constructive backdrop that's sustained, and that's where there's a risk of confusion, we think. So hashtag confusion that for us is a starting point of many conversation.
What does the fiscal impulse of this natural disaster, this pandemic, what does it do to the geometry that any given central bank faces? It's not in the textbooks, is it?
It's not in the textbooks, and we call this whole kind of complex. Well, we've talked about a policy revolution over the last few years. This complex of both monetary policy and fiscal policy moving very aggressively. But that leaves us at a place now where we kind of forget about this, but the debt levels are very high. Not long ago, the narrative in the U.S. was the debt servicing costs are so low, like at record levels, low, that we can afford to increase the debt very significantly, which we've done. The flip side of this, which we'll see soon, is that it won't take much in terms of rate increase to change this story completely on its head. We can have the 10-year back at 2.5%. And at that point, debt servicing costs in the U.S. will be back to their historical level, throwing completely out the window, the argument that Summers and Blanchard were making just a couple of years ago. So, point being, to your point, Tom, it's not textbook, and it's going to be a constraint on how quickly rates can go up.
Jean, I find this fascinating, the idea here that central bankers and frankly policymakers in general don't want to see rates go up too high because the economy is no longer able to withstand it because of what you're just talking about. Does that mean that the more volatile asset class is perhaps short-term yields that have very little room to maneuver but could potentially be offset dramatically by what people might speculate about policy changes, whereas stocks continue to be supported no matter what by the negative real yields that you see persisting?
Yeah, it's certainly consistent with what we've seen over the last month or two, right? I mean, lots of swings around the repricing of near-term policy, and yet the backdrop has been, continues to be constructive more broadly for risk assets. So I think that would be consistent with, rates might be lifting up at different point in time, but there's a conviction that overall, this is going to be a muted hiking cycle. And if it were not, I think we've seen some example of that, then markets are quick to price some kind of policy mistakes or quick reversals of policy, which speaks to this environment we're talking about. It's going to be difficult to raise rates, or another way to put it is like any rate rise will have a bigger impact.
Jean-Bavin, I'm honored to do this with your work at Princeton. As you know, the great Olivier Blanchard of France, of MIT, and of the International Monetary Fund. Professor Blanchard is out with a blistering note this morning in the Peterson Institute saying, forget about Team Temporary, forget about Team Gloom. John mentions Dr. Ilarian. He says we need to get used to the consequences of higher inflation. What are the consequences of a sustained higher inflation, as Olivier Blanchard mentions?
Well, I mean, it feeds through the entire economy. So, there will be adjustment through, obviously prices, but that means also we'll see some wage dynamics, that nominal wage dynamic that will be different. And eventually, workers will want to keep up with this inflation. It's going to change the bargaining kind of situation, and I think we'll see wages catching up. We haven't seen, I don't know, I haven't read yet Olivier's piece, but I would suspect like one of the key points is for the last 20 years where, inflation was missing in action. And even if we are, 2.5% world going back, after some spikes, it's going to feel different for that reason. And the other big point is how will people react in terms of their expectation of inflation? And I don't think we have collectively a good handle. There's no good models of inflation expectations. And so that's a big unknown, I guess, that we'll need to track and live with now.
Jean, always great to get your thoughts, sir. As always, fantastic. Jean Bavin there of BlackRock. On this equity market, global markets, the economy too. And Tom, that's what's really interesting about this moment. If I can guarantee you, say, the 5% CPI that Wells Fargo are looking for next year, together with the 4% real GDP target too, if I can guarantee you that, you'll have some people in this equity market, Tom, that want to stay long, think corporate America can adapt, profitability will still be great. Others who say the deceleration from growth from 6 down to 5 down to 4, together with the pressure on margins, it won't be as good. That's why we're still so divided on the outlook, even if I can guarantee you what the economic data will be.
I mean, John, correct me on this, but the Blanchard note is absolutely blistering about, look, let's grow up and stop with the childish media phrases and look at where we are. He's focused on the economy, on finance. But, John, is our focus next year going to be on emerging markets? Olivier Blanchard says, look at that.
They're already making a move, Tom.
Yes, that's
Hikes
my
in
point.
Mexico,
Yes,
Brazil. They've already made a move. It's already happening. Never mind next year.
Yeah, no question about it.
Equity futures up 10, advancing 0.2%. Heard on Bloomberg Radio, seen on Bloomberg TV, getting you to the weekend finally. From New York, this is Bloomberg.
With the First World News, I'm Ritika Gupta. Healthcare giant Johnson & Johnson will split into two companies. One will be focused on drugs and medical devices, the other on its well-known consumer brands such as Band-Aid and Tylenol. The consumer unit contributed 17% of J&J's sales in 2020, whilst the drug unit was responsible for 55%. A warning from the US on Russia. Bloomberg's learned that Washington has told the European Union that Russia may be considering an invasion of Ukraine. The US has been monitoring a buildup of Russian forces on the Ukrainian border. All this is occurring as tensions flare between Russia and the EU over energy supplies and migrants. Russia says talks of an invasion is unfounded. In Japan, the government reportedly is coming up with an economic stimulus package of more than $350 billion, according to the Nikkei newspaper. The package will include benefits for those 18 and younger. Japan's economy is forecast to have slipped back into contraction in the quarter that ended in September. Elon Musk keeps selling shares of Tesla. According to a new filing, the world's richest person unloaded almost $700 million of stock in the electric car maker. That brings Musk's total sales this week to about $5.7 billion. Some of the trades were made under a plan he established back in September. Tesla is down 13% this week. The number of women enrolled in MBA programs across the U.S. has hit a record high. That's according to the Forte Foundation, a nonprofit working to create gender equity in business. It says women make up 41% of incoming classes in 55 business schools, up from 38.5% last year. The foundation says the Great Resignation may be one of the reasons for the increase. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Are talking about Bloomberg surveillance.
There's some guy out on Twitter who says, I look like I'm on.
I noticed that.
Do you think I need a lift? Is it time
What
that
did he say about me? What did that particular gentleman say about... Let's have a look. One of them is near 101 years of age.
Which one would that be?
The other has an ego in the orbit of Mars. Who's that?
I had no idea.
Mrs. Lisa, the only chance to productive conversation. It's a fairly accurate summary of this show, isn't it, Tom?
The eyes, or should I do the whole thing? Where's the common ground on energy that you share now with the Prime Minister of the United Kingdom?
We are both very committed to the transition to a net zero future, and as part of that, to building up the renewable energy capacity for Scotland and the UK. Scotland has got massive potential in wind energy in particular, onshore and offshore, but also some real potential in new and emerging technologies, carbon capture and storage, for example. There's also, I think, an understanding, and perhaps the UK government and I don't entirely agree on the detail of this, but we must accelerate the move away from fossil fuels. We've got to do that carefully in a way that protects the people who are currently employed in that sector, in Scotland around 100,000 jobs, and do it in a way that doesn't see us importing more oil and gas, but instead moving to the alternatives.
I was just finishing what you were saying, Tom. November 3rd is when the decision is. Just in case people got confused, I will. Just one more story, Tom.
Yeah, thank God for that.
We're at 1:37 right now. Into weakness. Is this where they play the music and the Academy Awards? Is this it? Do I thank my mum again? Are you in charge of this?
Is she the only one?
Kill the music. You know who's in charge here.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
I believe in progressive income tax structure. I believe rich people should pay more in taxes. You know, the question we have to deal with as a nation is coalesce around the question: what should the maximum tax rate be on wealthy people? Because that will define the revenue to the government. The government has to size themselves to that revenue yield. Okay, and all this talk about wealth taxes, it's all baloney. They said let them close the loopholes.
Leon Cooperman there, the chairman and CEO of the Amiga family office from New York City this morning. Good morning. Tom Keene, Lisa Bramett and Jonathan Ferro. Your equity market up 10, advancing 0.2% on the week. The S&P negative about 1 percentage point. Looking to take some of that out around the opening bell. Yeah. Yields are higher, not as high as they were earlier in the session, up by a basis point or two to 156.47. Euro dollar is unchanged at 114.51. And crude, some good news maybe for this administration and the country. Crude's coming in a couple of percentage points rather, at $80 flat on WTI.
We are advantaged this morning with Jonathan Ferro with his experience in continental Europe and London, and also with Anne-Marie Horton, our Bloomberg Washington correspondent, who has had tours of duty, military combat in London, including much of continental Europe, including Eastern Europe. We've got a lot of topics setting you up for the end of the year and into next year. And out of nowhere is goofy sourcing, really strange reporting, including an excellent article by our Alberto Nardelli, Jennifer Jacobs, and Nick Wadhams on the Secretary of State, Ukraine, and Crimea. Anne-Marie Horton, it's wonderful to see you this morning. We've got to rip up the script here and talk about this. The AP publishing moments ago, our Bloomberg story, it's all so opaque. Why is this debate about Putin, energy, Belarus, Crimea, March of 2014. Why is it so opaque?
I wouldn't even
now?
say March of 2014. We saw a Russian troop buildup in the spring, and that really was tempered when President Biden then had this summit in Geneva with President Vladimir Putin. Right now, what you are seeing and what the Pentagon is calling a little bit unusual in size and scope in that buildup of Ukraine, but I'm not exactly surprised. President Putin has said the greatest geopolitical catastrophe of the 20th century was the breakup of the Soviet Union. This is an individual who has his eyes on securing Crimea and whatever he can get from Ukraine.
Let me describe the map. Kiev, you've been there any number of times, 60 miles away from the southern border of Belarus. Russia's over there to about 2 o'clock on the clock. And down south is the Black Sea. We are showing the flag in the Black Sea right now. From your sources in Washington, is that enough?
Well, the Kremlin right now is pointing to that as one of the provocations they are seeing, as the U.S. is saying, you have this buildup on the Ukrainian border. We are watching you. We need you to step back. What the Kremlin is saying, well, look at all the U.S. troops in the Black Sea. That's exactly right. It's interesting right now what is going on in Russia, particularly as well. You just had the Ukrainian foreign minister Wednesday meeting with Secretary Blinken. They spoke about Russia, what is going on. Blinken said we don't want Russia to use gas as a weapon. The Ukrainian foreign minister immediately was like, they already are. And then you look at what's going on in Belarus. And right now, Belarus, I would say, is really a big tension with Poland.
And
right
the
now.
other tension, Lisa, here is Merkel exits stage right.
Well, and the backdrop of this is an oil and gas crisis, an energy crisis across the European continent. How much does that play into some of the tensions that we're seeing with Russia and Ukraine, Anne-Marie?
Well, massively. Putin wants that Nord Stream 2 signed, dotted, and he wants the gas flowing as soon as possible. That's in the middle of going through a process, and of course, the U.S. has been against that. Then you look at what's happening in Belarus. Now, the European Union is saying to President Lukashenko that they need to stop in terms of pushing migrants towards that Poland border. And what you're seeing is very, very scary conditions for these migrants, freezing cold weather, humanitarian issues with potentially getting them food. And what Lukashenko is threatening is he is going to cut off the Belarusian pipeline for gas to Europe. So it's very difficult right now when you look at potentially higher energy prices. Europe already is coming off of what we already had, a month of crisis in terms of natural gas into the country, and this is a choke point. And to Tom's point about Merkel exiting stage left, this is huge. Angela Merkel really is the interlocker to President Putin. President Putin speaks fluent German. They spoke already this week at least 2 times. This is an individual that he takes the phone calls of and listens to, and she's not going to be around very soon.
Going to from Europe to the United States, when it comes to the oil situation, it is a global one, and particularly as the Biden administration tries to bring down gas prices. There was an article in the Bloomberg today talking about how there are a lot of disagreements in the cabinet of President Biden. How significant is that when it comes to a lack of a cohesive policy in the near term?
There's disagreements because there's a number of people in the administration who were brought in to make sure they can have a transition to renewable energy, right? He wants to be a climate president. He ran on climate change. And now you have higher gasoline prices, and that just means that you have to be more welcoming of the fossil fuel industry. Right now, there's going to be disagreements on what the next action is. Of course, anything that's decided, the president himself has to sign off. He has a massive to-do list at the moment. The most likely scenario would be tapping the Strategic Petroleum Reserve. We did it in 2011 when Libya's stock was low. We did it during Hurricane Katrina. The issue with tapping the SPR is potentially it could just be short-term, a Band-Aid. We're not even into those colder winter months. And to do it, the U.S. would really like to do it with friends, with India, with Tokyo, with some of these other consuming countries that are also feeling the pinch right now with higher gasoline prices.
Anne-Marie, is there a Gucci sale? Is that why you're up here?
There's not a Gucci sale.
There's not? You sure about that?
Unless Tom's taking me.
Anne-Marie Hordern. On the latest here in New York City. Anne-Marie, thank you. Thank you very much. Didn't ask about the Fed chair to Anne-Marie because right now we don't really have many answers. Got a response from the Kremlin, the spokesperson out of Russia, Tom, saying that they didn't discuss the threat with Belarus and Russia before they made that threat, the threat from President Lukashenko about holding back the gas. Russia's saying that they are and will remain a country that always fulfills its contractual commitments to deliver gas to European consumers. The reliability of Russia as a supplier and as a partner under current and future contracts is beyond doubt. Just setting the stage, Tom, going into the winter months of this year.
We'll let the markets talk. Ruble weaker this morning.
Yeah, and that's the move, Tom. I'm with you. Dollar ruble, a move of 1 percentage point, but that hasn't been the move of this year, right?
No,
we've seen some
well
real
contained.
ruble strength through 21 so far.
Well said. And this is really important, folks. This is a partition, what we see in ruble dynamics, from something really ugly, like I'm seeing a 9.94 Turkish lira as it revisits near a 10 level, or Argentinian peso at 100 non-black market. I mean, John, those are different stories.
Things are tense, Lisa. That's pretty obvious, isn't it, as we close out this year?
And the backdrop of the energy crisis making things all the more tense as people try to fortify their pipelines, fortify their message, their modes of getting oil and gas. I do wonder, though, how quickly this changes next year if you start to see supplies come back on and demand normalize with the normalization of the global economy.
The bottom line, we're talking about this and we're not talking about the end of COP. Isn't that what Russia wants right now? Lisa, ultimately?
Not just Russia, but also Saudi Arabia. The irony for them that they're being asked to pump more oil at the same time that global leaders are joining together to try to figure out how to get the world rid of oil.
Tom Keene, Lisa Bramett, Jonathan Ferro, your equity market up 10 on the S&P 500, advancing 0.2%. This equity market has a lift to close out the week, just a subtle, mild, little one after a week of losses. It's very much still on the cards. Yields are higher by a couple of basis points. Let's call it 2 on 10s to 156.64. In just a moment, I'll discuss euro dollar, which is flat on the day but negative on the week. Biggest weekly loss in about 5 or 6 months. This is Bloomberg.
Engine number one was able to do on the Exxon fight, it opened a lot of people's eyes to, I guess, the power that smaller investors can have. And I'm curious as to how other people can sort of look at what you did and use that is either a template or maybe just some sort of guide as to how they can sort of approach their relationships with other companies.
We founded the company in Engine Number One on the idea that we take the data, not ratings and rankings of ESG of the past, but we actually take the environmental, the climate, the social, worker data, and we simply use it to look at the valuation of companies and look at it over a long period of time. And so if you think about it that way, you own these companies. Everybody that owns the company, whether you're a big institutional investor or you're a small retail investor, you own the company. You have a voice, you have a vote every year.
Yeah.
And so our approach is to use the vote and engage with these companies over time.
But that's always been the case. I mean, at least in theory.
It's such an interesting new world.
The world is changing.
For us, it's not about being first. It's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
It is really still day one for AWS and for our customers. It is still so early in this business.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Live from New York City this morning. Good morning on Bloomberg Radio and on Bloomberg TV. This is Bloomberg Surveillance, and here is the Friday morning price action. Equity futures up 0.2% on the S&P on a session. On the week, down about 1 percentage point as we go into Friday. I wouldn't call this one a mount up, Tom.
Yeah.
Just a little bit of a bounce after a weekly loss, perhaps, going into the opening bell 2 hours away. That's the equity picture. Here's the bond market story. 2s, 10s and 30s. On the week, 2s and 10s up by more than 10 basis points. That rate hike dance comes in. We start to play it once again. That's the story at the moment. Wells Fargo now looking for 2 hikes next year, 2 hikes the year beyond that. And that's why you see this 2-year back through 50 basis points again. On a 2-year this morning, up 2 to about 53. On 10s, let's call it 156, round it up and call it 157. That's the bond market picture right now and the rate hike dance. Here's the story for foreign exchange. Let's get to euro dollar. Switch up the board. The highs of the year, 123.27, if I remember correctly. January 6th was the high of the year for euro dollar. We're down about 7% since then on this currency pair. Euro dollar right now 114.54. And as he always does, Tom, I think Kit Jukes just wraps it up over at SocGen perfectly. Kit basically saying we have an inflation dynamic here in America that is crying out for tighter monetary policy. In Europe, quite simply, we do not. And for that reason, Tom, he thinks euro dollar is heading lower from 114.55, which is where we're at right now.
Yeah, and I'd look, John, this is important. I'd look for a reset here, maybe a shout out to Jordan Rochester, too, of Nomura, who, you know, maybe gamed this correctly. It is a parlor game. But, John, I wonder over the weekend if we get a reset where all of a sudden 112 is the new 114.
It sounds obvious now, though, doesn't it, Tom? But last year we were looking for something else. And that's why I started the commentary around euro dollar with the start of the year. January 6th, when we saw the highs of the year on euro dollar of 123. And, Tom, to be clear, people thought it would go higher from there. They were looking for that cyclical trade to kick in, that synchronized global growth story, and a weaker dollar off the back of it. And now we've got comfortable with the opposite as we close out the year, looking for a euro to move more negatively, Tom, off the back of maybe divergent monetary policy. All I know is that every year we play this game, Tom, this FX market can push the other way, and it can be painful sometimes.
Well, the dollar reset, it has been a resilient dollar.
But that's the story in the FX market. Euro dollar 115, 114.54. That's your cross-asset price action. Let's get you some moves this morning. And say good morning to Romain Bostic. Morning, Romain.
Hey, good morning, John. The big mover of the morning is Johnson & Johnson. Of course, the company making that announcement that it's going to effectively split into 2 companies, one that's going to include the pharmaceutical business and the medical devices business in one. And then, of course, that consumer business is going to be spun off as a standalone company. No word yet on exactly how much this is going to cost and who's going to lead that consumer business here. But you see the shares actually moving higher here. This is a bit of a reversal. Remember, the CEO has been talking up the benefits of having this sort of 3-tiered model, and that this would sort of continue and persist for a much longer period of time. There's a lot of questions as to why they're choosing to overlap that medical device businesses with the pharmaceutical business. Sam Fazeli over at Bloomberg Intelligence actually extrapolating that it could be sort of a play later to actually then spin off that device business. But right now, you're talking about 2 separate companies, at least within about 18 to 24 months. That's going to be the 2 standalones here. It'll be interesting to see how investors react to that new consumer products business once it is finally spun off, and what ends up happening, of course, to that medical device business. Also in the deal space, this is interesting with Farfetch here. Richemont, of course, which owns Cartier and a bunch of other luxury brands like Montblanc, has kind of given up here on its on the strategy that it has had to create more of an online platform for some of its brands. It had done that through Utes and Net-a-Porter. It's basically now in a deal with Farfetch, where Farfetch is basically going to take off some of those online businesses and actually effectively run them themselves. Richemont will still hold the majority stake in it, but Farfetch will primarily be the main beneficiary from a revenue standpoint. It will also be the primary one on the, with regards to operating those businesses. Those shares up about 12% right now. And keep an eye on Tesla here. Shares flat on the day. Another share sale that we learned yesterday on November 11th. Basically another $1 billion worth of shares out of Elon Musk. Flip up the board, a few analyst movers to keep an eye on here. NVIDIA down here after a downgrade a little bit earlier this morning. This over at Wedbush, this is primarily a valuation call. Remember, NVIDIA was up about 50% just in the last 4 weeks alone. And then you have Penn National Gaming getting an upgrade today. This is also a valuation call, but that's because of the 60% drawdown that we saw on these shares going back to its peak in March. And Hewlett-Packard Enterprises, this is interesting. They're actually downgraded to sell today. Over at Goldman Sachs, some interesting commentary in that note here about a potential slowdown in IT spending. Keep an eye on HPE as well as some of the other IT services companies in this space, Tom.
Romain, thank you so much. To close this afternoon on Bloomberg. Right now, an important essay by Seema Shah. She's Senior Global Investment Strategist, the Principal Group. And Seema, I want to drill right into what we see on emerging markets. You are bold into the end of the year. you are bold into the beginning of the year and say you may not be on board with EM, but the beleaguered EM has your attention. Tell me about the when of diving into EM. What do you need to see to generate a belief in emerging markets?
Hi, Tom. So I think the key thing is China, right? We look at the fundamentals of emerging markets. We feel that there's a lot of promising movement with regards to vaccines, a kind of a shift away from zero COVID in a number of countries. And also, compared to a lot of the other parts of emerging markets, Latin, Eastern Europe, emerging Asia, kind of, not having as significant rate hikes. But really, the catch-all is China. We need to see some kind of movement there with regards to stimulus, potentially a bottoming of growth, maybe a pullback in a bit of regulation. And the problem here is that we don't know when that will happen. We think there is a pain threshold, but unfortunately we're not able, I don't think anyone is able to call that timing. So the only thing that we can do here is stay ready on the sidelines waiting to increase that exposure, because valuations have become more attractive, but we just need China to play ball.
Seema, what's your read at the moment on how far down the road we are in these tightening cycles in places like Brazil, like Mexico? Are we close to done yet?
I think we're definitely getting there, right? So, Russia, we're almost at the end. Brazil, I think that they're going to move quickly. They're going to move a lot, and then we should kind of normalize by middle of next year. So I think 2022, and the fun thing is they're going to be finished with their rate hikes. They're going to have gone to pre-pandemic levels before the Fed even gets going. So we have to take that into consideration. So I do think that as we get into 2022, developed markets start really moving faster towards their normalization process, that actually emerging markets start to look a little bit more attractive at that point.
Okay, so they look more attractive. However, there is the issue of the dollar. What happens if the Federal Reserve does hike twice or even 3 times in the next 18 months? How much does that potentially crimp the bet that you're making?
Yeah, we think that for the US, actually we're not expecting kind of very, very early hikes. We think it's going to be right till the end of next year that they're going to look through a lot of that inflation tension and wait there. And then from there on, actually have quite a shallow upward trajectory. We think, we look at the debt markets, we look at, the fact that the growth profile is on a slowdown, and we don't see very significant moves. So I think there is upward movement on the dollar, but I don't think it's going to be to a point that it starts to strangle emerging markets.
Meanwhile,
and actually the other thing is that, I know a lot of investors have been really concerned about how do emerging markets deal with Fed tapering. And at the same time, there are investors who are looking at emerging markets and thinking, right, well, there's a far more credible monetary policy framework, more credible on the fiscal side across a number of countries. And I think that actually this is a slightly more stable emerging markets than what we've been used to in previous years.
So this is a really constructive outlook. Why then are you seeing potential wobbles in the U.S. equity markets, considering that there is this sort of reflation trade and a constructive narrative around to the rest of the world?
Well, so even for the United States, look, we're looking at a growth slowdown, but we're still expecting growth to be around trend, if not above trend. Right? So this isn't a very, very negative outlook at all. There are going to be pressures on profits. We need to keep a very, very close eye on that. But when we look at earnings, the earnings season just gone, I think that equity markets have generally been really encouraged by signs that there is continued strong demand. So, we are expecting lower returns through 2022 in a number of markets, including Europe, including the US. But are we looking at negative returns? Absolutely not.
What's the correlation here to weak dollar? Basically, EM investors are standing around waiting for a weak dollar. Is that all this is about?
No, I think emerging market investors are really watching to see what happens with China. And it's too big to ignore. It has to be something that is working for them. But having said that, there's pockets within emerging markets away from the EM Asia, such as in Latin America, where valuations are starting to look more attractive. I think it's just being ready for that opportunity. Don't go too underweight in your portfolios. Be neutral and be ready to increase that exposure when the right time comes, when China does start to pull back a little bit from a lot of the various regulations, tightening constraints that they've started to introduce.
Seema, thank you, as always. Great to catch up. Seema Shahdev, Principal Global Investors on emerging markets right now. And when you take the MSCI Emerging Markets Index, we often do this, Lisa, but just to lift the lid on it, Tencent's about 4.5% of the index. Alibaba's another 4% of the index. There's a big China bet embedded in that universe.
And we're hearing more people talk about the fact that China is going to be forced to ease policy, actually going in the opposite direction than the rest of the world because of what's going on with respect to home developers, with respect to their zero COVID policies and the trickle out into the economy. Is this something that actually makes China more attractive to many investors? That's what I'm hearing increasingly, John.
Or do you want to go ex-China? If you go ex-China, Tom, there's opportunities out there. If you just look at the benchmark, we're down 0.4% year to date so far.
I am by no means an expert on this, John, but it's amazing how the conversation has shifted, as we saw from Ms. Shah, to a focus on China. I'm going to lean over the desk and read Stephen Englander of Standard Chartered Bank. Terry Weissman of Macquarie is absolutely lights out phenomenal. And I still go to the overwhelming coefficient is weak dollar.
From EM to DM, your equity market up 9 on the S&P 500 this morning, advancing 0.2% as we inch towards the weekend. We head towards a weekly loss on the S&P. Your bond market shaping up as follows. Yields higher by a couple of basis points to 156.82. And you know where the conversation is this week? It's on one thing. It's on a big CPI print in America and what it means for this Federal Reserve. And as we look ahead to next year, Tom, when do we find out about who leads this Federal Reserve?
Well, we've hardly talked about it today. It's been sort of a relief. This weekend?
We have nothing to say. That's the reason why.
We had some reporting in the last 24 hours that indicated that some of the stocks trading would not be part of the decision as to whether to give Chairman Powell a second term or not. So that apparently, Tom, won't count against him, according to some of the reporting that we've done.
I don't know, like 5 p.m. today?
Who knows?
I don't know.
And Tom, let's be clear. It's got to be a package, right? It's not just him. Lisa, it's others too. There's a lot of open seats on that Federal Reserve.
The fact that that's the only guidance that we're getting and a sort of anonymously sourced story saying that the trading won't work against him tells you where we are in this cycle and how late we are, frankly.
We're waiting for a decision from this White House on this Federal Reserve. Tom Porcelli of RBC is going to join us shortly. I'm looking forward to that. I know you guys are too. Equities up 9, advancing 0.2% on radio, on TV. This is Bloomberg.
With the First Word News, I'm Rishika Gupta. Oil is heading for its longest run of weekly losses since March. President Biden is keeping investors guessing whether he'll intervene to hold down prices that have hurt consumers. The price of gasoline in the U.S. has hit a 7-year high. The president is considering a number of moves, including, of course, a release of oil from the Strategic Petroleum Reserve. It's one of the messiest spats amongst Democrats as they try to pass a tax and spending package. The state and local tax deduction known as SALT. Donald Trump put a $10,000 cap on it. Democrats from high-tax states want to expand it as part of President Biden's economic plan. Progressives are opposed, so some version of a SALT cap may remain. Donald Trump has got a court win to shield his presidential diaries, call logs, and other records. For now, a federal appeals has temporarily granted the former president's request to keep the documents from being released to a congressional committee investigating the Capitol riot. The court will hear arguments in the case November the 30th. At those climate summit in Glasgow, talks on creating a global carbon market have run into new obstacles. Countries disagree on how to account for emissions credits that get sold. Talks will continue today with less than 24 hours to go before the summit is set to wrap up. And in Florida, a prosthetic-tailed dolphin named Winter that starred in the Dolphin Tale movies has died. Officials at the Clearwater Marine Aquarium say they were preparing to treat the dolphin for a gastrointestinal abnormality. Winter was 2 months old when she lost her tail in a crab trap. The movies chronicled her recovery. Winter was 16 years old. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts. I'm Rishika Gupta. This is Bloomberg.
has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
We have the energy crisis, there's a lack of drivers. Is there anything that you need to ask authorities to do better or that your clients want the UK to do better?
I think we're at a moment in time where we're coming out of the pandemic and there are a handful of things going on. I think all over the world there are labor issues that are really a reflection of this transition out of the pandemic. There are supply chain issues. Some of this stuff is transitory. There are some secular trends that we have to watch closely. But I think we're adjusting and dealing with it as anybody else is. And I think leaders here are thinking about it the same way leaders are around the world.
When you look at the UK and of course some of these green investments that the UK and the City of London particularly has been really trying to pitch, you've been extremely involved in carbon offsetting. Can London really spearhead that movement?
Well, I think it's important that governments around the world partner with the private sector to try to get capital directed toward innovation in a way that we can accelerate the climate transition. And I want to emphasize it's clearly a transition.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
You talk about hiring aggressively at the moment. Can you walk me through how challenging that is at the moment? How difficult is it to find the right people?
Well, things have changed. Again, the world has changed under the pandemic, and you all know worldwide, what the challenges with getting people back into the workforce.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
It's going to take a while to dig out of the hole we're in, and it's mostly about getting labor into jobs. We need more truckers. We need more warehouse workers. We just need to be more fluid so that we can match supply of capacity with demand from consumers.
JOLTS data coming up a little bit later in America. That was Lance Fritz there, the chairman and CEO of Union Pacific. From New York, alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Your equity market positive 9, up 0.2%. Yields are higher by a couple of basis points to 157, let's call it, 156.82 to be precise. Later the data, 10 a.m. Eastern time. It's JOLTS and you, Mitch.
University of Michigan, I'm really curious to see how much we get a decline in sentiment in tandem with higher inflation expectations. The resilience there actually giving some people even more optimism.
Job openings, Tom, running at 10.4 million in America right now.
For those keeping score at home, Michael McKee really cares about the JOLTS data, John.
Looking forward to it, Tom. A couple of hours away.
Very good. This is the hallmark of David Wilson's career. He says, who's out there smart? Who's doing something smart? Let's bring it to the Bloomberg public. He's made a career of it, and he does it again today, as he has so many times with a gentle lady from Charles Schwab. I saw the same chart you saw, Liz Ann Saunders, yesterday. Lights out.
Oh, absolutely. And what we're talking about here are inflation-adjusted or real earnings yields on the S&P 500. You figure the index at about 25.5 times earnings, that works out to an earnings yield of 3.9%. Problem is, the consumer price index data that we got this week shows inflation running at 6.2% for the latest 12 months. And so you put the two together and you get the most negative real earnings yield on the S&P 500 going back to 1957 when that index was introduced.
One more question on radio, folks. This is a rare event we're at right now. What happens after you spike down?
Well, I mean, that becomes the issue because the previous record was set back in March 1974. You had a bear market going on. You had a recession going on. Clearly, the circumstances now are different because you've got an expanding economy. You've got an S&P 500 that's been setting records. So the real question is, do you get the reversal? And does it come perhaps because inflation does prove as transitory as the Federal Reserve might like it to be?
David, over the weekend, figure out who the next J&J GE is. I got to make some money. David Wilson with us here with the charts of the day. Speaking of Johnson & Johnson, Dr. Fazeli is in the house, our senior pharmaceuticals analyst. I can't say enough about his academics. Sam Fazeli, did J&J do this because of litigation?
You know, that speculation is going to have to happen, Tom, right? Because it's been years that they've been asked, why don't you split the company up? And so suddenly now. So you're going to have to speculate about that. But honestly, I don't really care. This is the right thing to do, and I'm glad they're doing it. This business has no synergies really between shampoo and getting drugs that high-tech drugs that treat difficult cancers. So it never was, should have been together, and I'm glad just they're doing it. And now you can see the results in the share price.
Do you imagine that this will go across all of global and Western pharmaceutical, including troubled companies like Glaxo?
Well, that's already happened, right? Glaxo's already decided that they're going to get the two companies split. And now Glaxo doesn't have any more to do after that. J&J, my biggest question now is, why not go that last step and move out of medical devices? Put that into a separate company too.
Sam, why now?
You know, as I said, I'm really happy that they're doing it. Maybe it's to do with that issue of the litigation. But honestly, each of these businesses is now definitely big enough to be very significant players.
Not just particularly that litigation issue, but also the idea that Johnson & Johnson had the inferior shot to combat COVID, the idea that its inoculation was not as successful as the others from Moderna and Pfizer. How much does mRNA development, the idea of trying to get on the cutting edge of biopharmaceuticals, part of this as well?
Yeah, I really don't think they're related. I mean, the J&J vaccine, the reason that it's not showing the same level of efficacy is simply because it's a single shot. Everybody talked about it. It was the right thing to do perhaps at the time for them. Get this vaccine out, single shot, prevent as many deaths and hospitalizations as possible. But you just can't get away with one. It looks like you can't even just get away with just two. So that I don't think has anything, a lot to do with this. And I'm looking forward to seeing more information from them as they develop their vaccine platform.
Sam, the romance of the business, either consumer or frankly the research combine of pharmaceutical, it's all drifted away into a modern competitive world. When does Amazon show up to do the distribution, frankly, of all three divisions?
Yeah, I mean, look, I think for the prescription level pharmaceuticals is going to be still quite difficult, especially that you need the physician to be there. But Amazon's already there. I buy my acid reflux tablets off Amazon because it's the cheapest. So as soon as you go to see, I think that's definitely a company that you can get together with.
Sam, if Lisa bothers me, do I have to take acid reflux tablets? Is that what you're prescribing?
You haven't yet? Is that what you're saying?
I hope you never have to do that, Tom.
Sam, just a final question to tie things together. How important is this breakup, either as a harbinger of what's to come in similar types of companies or a statement on the nature of this industry?
Yeah, you know what? I think, Lisa, they've probably been pushed just one last step by their shareholders. Say, look, if Glaxo can do it, why can't you do it? Why don't you split this $450 billion behemoth into the segments where you will get value add? There's no question, because that's exactly what the share price is telling you today. So these businesses should be separate. I think they're probably the last one to do it. Maybe Sanofi, but they're small compared to these guys, given the $14.5 billion of sales for consumer this year expectations. So I'm really glad they're doing it now, but they're really at the kind of end of the queue now.
Sam, thank you, sir. As always, Sam Fazeli, our good friend down in London of Bloomberg Intelligence. That stock is up by almost 3% in the pre-market, 167.89 on J&J. Let's set the stage for the next hour on Bloomberg Surveillance. Coming up, Dan Morris of BNP Paribas Asset Management and Christian Muller-Glissman of Goldman Sachs on Tom, their top trades for next year. from Goldman. That conversation about 30 minutes away.
Still what it's about, John. You know, I'm glad you bring that up. It's November 15th this year, a key weekend, a slide into the holidays. And you know what? It's still about making money. It's still about what do I buy next? What do I do with cash? That's still the heart of what we do.
The outlook for next year, Lisa, what will it feature? Higher interest rates, CPI in and around 5%. That this morning is what Wells Fargo thinks.
And the other thing is the fact that bears have basically been rendered obsolete. The biggest bearish call you're going to get is wobbles in the S&P that will be buyable dips, or basically the idea here that low yields will give a persistent push and prevent anything from falling out of bed. I don't hear a lot of catastrophic calls. In fact, I've not heard one, John.
When do we get the Bremo outlook? When does that drop?
That drops on December 31st for that year.
John,
for that year, looking back.
Got it grossed out over. It's over 64 pages right now.
Oh, yeah?
It's up to 64.
Yeah, it's like she's like doing a PowerPoint like Mary Meeker. I mean, it's like, you know, going to be 272 pages.
You should...
A monthly subscription for Bremo's Bears. How much is it, Lisa?
Oh, it's really expensive.
$9.99 a month.
You got to pay in Bitcoin.
You've got to pay in Bitcoin. Okay. Equities up 0.2% on the S&P. We advanced 9 points. From New York City this Friday morning. Good morning to you all. On radio, on TV. This is Bloomberg Surveillance.
Хорошо подготовлены, насколько это было возможно за столь короткие сроки. Это на самом деле эксперимент. Поэтому мне не хочется употреблять такие слова, как страх, боязнь и все прочее. Мне хочется говорить, что это очень волнительно, но одновременно и радостно, потому что, ну, вы же понимаете, как мало людей вообще там были. А у нас есть возможность полететь в космос, и не просто полететь в космос, а сделать там то, что мы умеем по-настоящему хорошо делать на Земле. Это снять кино.
У нас же экспериментальный во многом этот проект, поэтому мы сейчас столкнемся с кинематографическими нюансами, которые мы могли предвидеть отчасти, какие-то, наверное, не могли предвидеть, то есть несмотря даже на то, что, опять же, все делились с нами там космическим опытом и так далее, но это опыт, это первый раз, то есть второй будет проще.
What's happening on Wall Street?
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
People are talking about Bloomberg surveillance.
There's some guy out on Twitter who says I look like I'm 101.
I know, I noticed that.
Do you think I need a lift? Is it time
What
that
did
I
he say about me? What did that particular gentleman say about... Let's have a look. One of them is near 101 years of age.
Which one would that be?
The other has an ego in the orbit of Mars. Who's that?
I have no idea.
Mrs. Lisa, the only chance to productive conversation. It's a fairly accurate summary of this show, isn't it, Tom?
The eyes, or should I do the whole thing?
In this negative yielding world that we're in, all roads still lead to equities.
Real yields are at historically low levels, and those levels can persist.
The way to beat higher rates or to beat inflationary pressures is with record high profitability.
Liquidity is coming into the market still, and it's making its way around to a wide variety of asset classes.
Ripping away stimulus and slamming on the brakes, it probably won't be good for anybody in the global economy.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television, a simulcast. Get out the calendar. It's November 15th. We do the Great Reset into the holiday season, into 2022. And John Farrow, 35 days to the Farrow holiday.
I'm almost gone, Tom. I'm almost gone. After that ECB decision, I'm out of here. That CPI print this week really shook things up for the outlooks into next year. Wells Fargo this morning, we've talked about it repeatedly, looking for 2 hikes next year, 2 hikes the year after that. When you get the CPI call from these banks, Tom, you have to ask about the GDP call that goes with it.
Agreed, totally.
5% CPI at Wells, that's together with real GDP of north of 4%. That's still punchy, Tom.
And what is so humbling here, as you mentioned, I think in the last hour, John, how everybody got Europe wrong 12 months ago, maybe 10 months ago. Right now, the great speculation is, what do we get wrong into 2022? And it's got to be the growth trajectory. It's a mystery.
Bank of America bearish. Bottom line, they're looking for a 10% decline in European equities in the near term, Tom. We expect the anti-Goldilocks combination of weaker growth momentum, rising real bond yields to weigh on European equities. That's their call. Those calls, Tom, are starting to build.
In the political soup here, Lisa, I've been watching the redistricting debate, which is really starting to heat up. The overlay of all this is the convoluted politics of early next year.
Yeah, the idea that policy uncertainty will grow with the idea of midterm elections,
Agreed.
probably turning the House and the Senate Republican if you get the same kind of wave that you're seeing right now. I do have to say that right now, the most bearish people are getting is little turmoils in the markets, right? We had today perhaps the capping of a tumultuous week. What, equities down what, 1% for the S&P? Woo, scary. First down week since the beginning of October.
Lisa is not impressed by those calls, Tom. She is not impressed.
Honestly, I just think that the bears have gone away, and that what we're looking at is real yields that are deeply negative, that are expected to remain so in the United States, so everyone's going long risk.
But, John, this is so important to Lisa getting pounded out in social media today on the edge of gloom. John, it's not that the gloom crew has gone away. They've just been humbled into a silence. They're still there, right?
Humbled by what you've said repeatedly this year, Tom, that corporate America has adapted. I've heard that from so many of my guests around the opening bell, morning after morning. Corporate America keeps adapting to the higher cost pressure. The margins have held up. Profitability has been decent. Until recently, the story has been earnings, better earnings. Then higher valuations started to kick back in. We'll get the call from Goldman on that specific point, Tom, in about 10 minutes' time.
I mean, Lisa, it's going to be important with Goldman Sachs. Lisa, do you see how John saves his best questions for 900? You see how he does that?
You're just noticing that now?
Every professional athlete has to warm up before they go and play the actual game.
You compare yourself to the professional athletes.
Yes,
that's what people should do.
This is a 3-hour warm-up.
Can I just say, the bears have gone away. We actually saw a short fund surrender this week that Russell Clark closed his fund. So actually, sometimes they are going away. Quick
data check, John. I'm going to go narrow here, not on dollar ruble weakening out on Eastern Europe tensions, but the lira can't find a bid today, 9.94. Turkish lira out ever weaker against dollar. I'm watching that into the weekend.
Lisa feeling lonely. When Lisa capitulates, you know the top is in this equity market right now, up 8 on the S&P, advancing 0.2%. I'm joking, maybe, perhaps I'm not. Yields are higher by a basis point, Tom. 156.30 on 10s, euro dollar, that 114 handle, Tom. Euro dollar 114.50, unchanged on the day.
To summarize here, and seriously to push forward, it was so good to have Mr. Fillon, the head of BNP Paribas North America, with us earlier in the week. His chief market strategist attends now, Daniel Morris. Daniel, what does your year ahead look shape up as right now? I know you're codifying it in French. What's it going to look like in the King's English?
Well, I think one of the key changes, and this is something we certainly should not lose sight of, is the prospect for earnings growth next year. If you look at current consensus forecasts for the U.S. next year on year, 2022, 2021, it's 7%. 4% in Europe. You actually get 15% in China, but compared to what we expect to get in China, it's not all that much. So the big challenge, aside from the discussions that we're having already around rates and what the Fed does, the ECB, is you're just not going to have that earnings momentum to really push the markets much higher next year. And of course, we appreciate the valuations are not particularly low.
When you look at these forecasts, Dan, from the likes of Wales, work with me here, 5% on CPI for next year, 4% real GDP growth for next year. Is that good for risk assets? Can you see it either way?
Well, I guess it's what are your alternatives? Generally, we've already seen this year that equities are going to be one of the most resilient asset classes when you're in either a high and or rising inflation environment.
Bit of a connection issue there with Dan Morris of BNP Paribas. When we reconnect, we'll allow him to finish his answer. I asked that question, Lisa, because in a world of 5% CPI and 4% real GDP growth, there will be some people out there who believe corporate America will keep adapting, profitability will keep on rising, and this equity market will keep on gaining. Unless something happens in the bond market, and you've been making this point. We had PGIM on the program yesterday, Robert Tipp, and the point that Robert Tipp made, he said, forget all this stuff about inflation, about higher interest rates. Look at what's happening with the long bond. We're still in and around 2%. It's not building higher, is it? Not in a material way.
And this is frankly pessimistic, right? Bond traders tend to be pessimistic. This might be the most bearish indicator out there. The idea that you even saw that curve inversion, the idea that 20-year yields were higher than 30-year yields for the first time since the reintroduction. This is indication we are not going to get long-term runaway growth. And without that, John, people see this as an accommodative backdrop in the near term that can remain Goldilocks for a bit longer.
We've reestablished that connection with Dan Morris of BNP Paribas Asset Management. Dan, good to have you back with us. Let's start again. The outlook, CPI of 5, real GDP of 4, why the equity market can still gain with those kind of numbers.
Well, I think we've got to keep in mind, one, with that more modest earnings growth projection, but even with the higher inflation, as you pointed out, we've had the ability, given the very strong demand you have on the consumer and the business side, that businesses are able to push through those price increases, and the pricing power you see for the most part in equities we think is going to be sustained. So we're not particularly concerned about the outlook for equities, just dialing back our expectations for how much they're going to be able to appreciate. And I think as it has been for a while, looking for as much now the relative value and relative return opportunities, given that we're not expecting a big rise for equities in aggregate. But is it looking at emerging markets, for example, to see if they're going to make up a lot of the lost ground that we saw over the last year?
Is that something that you're actually betting on, that you think that we are going to see a more traditional reflation trade with emerging markets leading?
Well, I think at this point, we're already rotating some of our exposure that we have from the U.S. to emerging markets. And there's kind of two rationales for that expectation. For one, we've already seen the support you've got from commodity prices. And if you think of EM ex-Asia, we anticipate commodity prices are going to continue to gain. And if you look at LATAM, if you look at EMEA, they're going to be able to benefit from that. But of course, the key thing is what happens in Asia. And after the underperformance, if we look at valuations and anticipating further support, particularly out of the Chinese government, we think there's going to be an opportunity for these markets to pick up and make up a lot of the lost ground. Another thing to keep in mind is if you look at U.S. returns relative to the world ex-U.S., you've never had a longer than 4-year streak where the U.S. outperforms. And this year makes the 4th year for U.S. outperformance.
How concerned are you, though, that the dollar might strengthen materially? The idea that if the Fed starts to hike in tandem with market expectations, it will potentially disrupt this trade in a meaningful way through the FX channel.
Absolutely. It's something we've seen recently, and we don't have a position currently on dollar versus the euro. We aren't expecting, though, the commodity currencies to kind of override that factor and expecting that they'll be able to benefit vis-a-vis the dollar. So we're looking for that trade, I guess, in a slightly different area as opposed to developed market currencies, say the euro, looking more at commodity currencies. And if you realize that commodities are priced in dollars, the threat from dollar strength should hopefully be mitigated.
Dan, would a different Fed chair change any of this for you? Could you see it moving the dial? I know it's an obsession right now. I'm just trying to work out how much would move the dial for people if we had a different Fed chair.
But absolutely, if it's a different person, different people on the committee, the assumptions then that the market makes about the prospect for rate rises or not, absolutely, I think would make a difference. At this point, we're working with the chair that we have.
Dan Morris there of BNP Paribas Asset Management. Thank you, sir. It is the middle of November, and we still don't really know who the Fed chair will be, Tom, in 3 or 4 months.
No, we don't. The hearings, I mean, what do we say? Every hour, every 12 hours that we move forward has got to tilt more towards Powell?
You'd think so, and then I think things are going to get a little bit more contentious in these hearings, Lisa, on either side of the aisle. Given where inflation is at the moment, I know this individual has huge Republican support. On the other side, we know what Senator Warren thinks about him.
And how the market responds, whether people really do believe that Lael Brainerd is going to be the more dovish pick. I got to say, John, I've started to write my outlook.
What's in it? What's the top line?
Well, the headline is, what does it mean to be a bear in 2022?
And what does it mean to be a bear?
I'm going
feels
deep.
Very emotional.
It's a very emotional question. I mean, are you looking at, something that's a significant downdraft? Are you looking at, the bond market having a bearish market? Are you looking at, a more hawkish Fed? These are the questions.
I've had great success folding in a bit of mindfulness and meditation into my book. Lisa, if you fancy it, working out.
All right, well, please ship me over a copy.
Because bears are always angry. I think they just need to, just
I
relax
wish I had
bit.
a publishing career like you guys. Where are we on drawdown meditation?
It's a few more months away, Tom.
A few more months
just
away.
wrapping it up. You know what it's like. These
you
publishers.
You and Ian Bremmer will
after
probably
edit.
get your books out at the
Morning
same
of
time.
Tang.
Probably.
That's yours.
Which one would you rather read, though, Tom? That's the big question, isn't it?
What does it mean to be a bear?
Do you want a chapter in this book, Lisa? I can offer advice to bears in the book,
for either
if you like. Equity Futures up 2/10.
Oh.
Tom, you'll do what you do with all the other books. Read a couple of pages and pretend you read the whole
Got that
thing.
right.
Read the back cover.
I've seen how this works.
Barry Eichengreen.
I really like
in
what you
defense
said
of
on page 2.
Which was the only page you read.
Thank
From
you.
New York City, this is Bloomberg.
With the first word news, I'm Rishika Gupta. Healthcare giant Johnson & Johnson will split into 2 companies. One will be focused on drugs and medical devices, the other on its well-known consumer brands such as Band-Aid and Tylenol. The consumer unit contributed 17% of J&J's sales in 2020, whilst the drug unit was responsible for 55%. A warning from US on Russia. Bloomberg's learned that Washington has told the European Union that Russia may be considering an invasion of Ukraine, and the US has been monitoring a buildup of Russian forces on the Ukrainian border. All this is occurring as tensions flare between Russia and the EU over energy supplies and migrants. Russia says talks of an invasion is unfounded. And in Germany, the 4th coronavirus wave is hitting with full force, and there's no sign of record infections easing soon. New daily cases surged past 50,000 this week for the first time. Some hospitals already are overwhelmed with patients. Officials say Germany needs to ramp up its vaccination campaign. Elon Musk keeps selling those shares of Tesla. According to a new filing, the world's richest person unloaded almost $700 million of stock in the electric car maker. That brings Musk's total sales this week to about $5.7 billion. Some of the trades were made under a plan he established in September. Tesla is down some 13% this week. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
finishing what you were saying, Tom.
Thank
November
you.
3rd is when the decision is. Just in case people got confused, I will. Just one more story, Tom.
Yeah, thank God for that.
We're at 137 right now.
Wrap it
into
up.
weakness. Is this where they play the music in the Academy Awards? Is this it? Do I thank my mum again? Are you in charge of this?
Is she the only one?
Kill the music. You know who's in charge here.
It's such an interesting new world.
The world is changing.
For us, it's not about being first. It's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
It is really still day one for AWS and for our customers. It is still so early in this business.
Will we get to herd immunity? Or let me ask it a different way. Have we given up on herd immunity as a practical matter?
You will know when you get to that point, when the cases are so low, they're barely detectable. That's what herd immunity means. We don't know what that percentage is, David.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
What is very unusual in this cycle is that the cumulative response to this kind of inflation that we haven't seen in 30 years will be much more muted than historically. And that's going to be meaning that real rates, in our view, are remain very low for a sustained amount of time.
We are running an economic experiment in real time. That was Jon Bavin there, the head of the Investment Institute over at BlackRock. Tom Keene, Lisa Abramowitz and Jonathan Ferro this Friday morning. Good morning to you all. Your equity market is positive, higher, up 9 points on the S&P, advancing 0.2%. NASDAQ futures up 36, also positive 0.2%. Yields are higher too, up on the week, up on the session. Yields up by a basis point or two on 10s, Tom. 156.47.
Right now on a Friday, as we reset for November, at the end of this year, and as John has mentioned, some of the window gazing into 2022, it's time that you reset. Christian Muller-Glissman at Goldman Sachs is hugely qualified to talk about the linkage of the dynamics of the market into your portfolios, retail and institutional, around the foundation back to 1926 of the 60-40 portfolio. Christian, thank you so much for joining and your work with the CFA Institute, of which I'm a member as well. How dead is the dead 60-40 portfolio?
Yeah, listen, it always is a bit aggressive to say that you have the death of kind of one of the most basic and well-known investment strategies. I think there's always going to be some benefit to be balanced, no? But I think you have a particularly poor kind of starting point for these type of portfolios from two perspectives, no? I mean, first of all, everything is expensive. We know that. And equities and bonds are expensive at the same time. That was actually the same a few years ago. And still, these portfolios continued performing really well. But what's new is how we are starting the cycle. No, the cycle is starting with more inflation and flatter yield curves. And that just means that what bonds can offer you in the portfolio is even more limited, both in terms of returns and with regards to risk reduction.
One of the other determinants here is diversification, which over my span I've seen, for example, 300 stocks down to Fidelity 50 years, what Sequoia did years ago. Tell us about your view on the new diversification if bonds are so unattractive. Do I own Apple, Amazon, and 7 other stocks?
Listen, it's exactly a good point you make there. I think you need to look for older sources of diversification than just what equities and bonds can offer you. I actually think there's going to be much more potential for regional diversification. In the last 20, 30 years, all the academic evidence is showing that there's no benefit of having a global portfolio. If anything, the best thing was to have all your money just in the US equity market. But now that we introduce inflation risk, inflation volatility, policy uncertainty, which we haven't had in the last 20, 30 years, and possibly much more macro volatility, desynchronized cycles, what we could get is more diversification across the markets and also across styles, across sectors, and the leadership is much less narrow. So to some extent, you should not just be in the winners of the last cycle and run a really concentrated portfolio. You need to branch out a bit. You need to diversify. And obviously, the other key area, which we all know and has already done really well, which will be more important in the portfolio, is real assets. If it's commodities or other sources of kind of real cash flows, I think that will also feature more heavily in the coming cycle.
Is cash better than developed market bonds right now?
Listen, this is the most interesting discussion, in my opinion, which is new. I think we all know that equities look better than bonds in the long run on most models which you can come up with. But the more interesting discussion is really bonds versus cash. People are forgetting, but bonds have for very prolonged periods of time lost you money versus cash. Actually, the hit ratio of cash outperforming bonds over a 10-year rolling period is nearly 40%. So it's nearly 50-50 that you essentially do better with cash than with bonds based on the last 100 years. We obviously have been in the biggest bond bull market on record, so we kind of feel that's quite unusual. But if you look back in history, there were plenty of periods. And one of the most important indicators of how bonds might do versus cash is the steepness of the yield curve. And the steepness of the yield curve is half of what we normally get after a recession, exactly to some of the comments we had earlier, because there's so little optimism about the duration and the longevity of the cycle and how much central banks can hike. That means you have less buffer and you have less return potential for bonds versus cash. So I think definitely cash looks better versus bonds in the coming cycle than what we've experienced in recent years.
How about inflation? Doesn't that sort of erode the idea because your buying power is steadily going away with no coupon?
Yeah, I mean, it's always like, do you want to lose money fast or slow? No, I think the big problem is with cash, you're losing money very slowly, whereas with bonds, you obviously have other drivers. And we all know that real yields have moved to incredibly low levels. And there's really weird relationship you currently have where inflation expectations go higher and higher and higher, but the real yields, they don't follow. And we know that might change, and then you have some losses in bonds.
Christian, one quick question. You can't have a Muller-Glissman article without an Ibbotson chart. You trot out the Roger Ibbotson chart like clockwork here, the long-term log performance of the equity market. And the great unspoken fear is another 1970s, the dismal 70s, the Carter malaise, the flatness of equity return. What's the probability of that?
Listen, I think it's definitely higher post-COVID and post the crisis than before, because we obviously have now this new inflation uncertainty. And inflation is I always say it's a very autocorrelated animal. Once you set it loose, I think it does create more uncertainty. It has spillover effects. And I think as a result of that, the probability has gone up. We still would argue that like a 70 stagflation, don't forget there was 10% annualized inflation over a decade. I mean, that is quite aggressive. And you also have to consider at the time, like the type of macro backdrop, both with regards to demand, supply disruptions, which were related to OPEC embargo, Iranian revolution. There were things going on which seem much more extreme than what we're dealing with. I think stagflationary momentum is something we need to fear next week, not next week, next year, where I think we know that growth will come down, inflation might remain sticky, and we get a bit of monetary policy normalization and potentially a bit of a catch-up for monetary policy, and that can be a bit harmful for markets. But I think the 70s stagflation to us is still a pretty extreme event, which I would still put more into the tail risk bucket, not the base case.
Christian, that was a clinic. It's good to catch up, sir. Send our best to Peter Oppenheimer as well. Christian Müller-Glissman there of Goldman Sachs. Thank you, buddy. It's good to see you.
John,
been too long, Tom.
John,
been too long.
Yeah, it was outstanding. Did you see how he channeled Lisa Abramowitz there at the end, talking about stagflation as a worry next week?
He was bringing up some important points, Tom.
That was good.
I don't know if he was calling out Lisa personally. Lisa, the point he made up there about cash over bonds, I thought was interesting.
Fascinating. I love it.
Do you want to lose money quickly or all at once or slowly?
It's fantastic, especially at a moment where people want flexibility, right, to possibly pivot if the data changes, if the positions of policymakers change, if the policymakers themselves change.
Yeah. Oksana Aronoff of JP Morgan Asset Management earlier this week, running 50% cash.
Amazing.
Wow.
Unbelievable.
What do you got in the real yield today?
A big conversation about the next Fed chair, Tom.
Okay.
Breaking news. No, I don't. Just to be very clear, I don't. Equity futures up 2/10. But tune in. This is Bloomberg.
I will.
The 700th anniversary of Dante Alighieri's death has triggered the work of many institutions and offered a very rich schedule of events. Today in Santa Croce, we present one of these projects that suffered a difficult start because COVID-19 has stopped the project that was shared by the Opera di Santi Croce by the Franciscan community from Florence Municipality and the Fund for Religious Building of the Internal Minister. Today, Felice Limosani's project is finally enjoyable. In the Pazzi Chapel, the marvelous architecture by Filippo Brunelleschi, the most important images from the Divine Comedy created by the French illustrator Gustave Doré. Through these images, we can live the violent emotions of hell, the weight of purgatory, and the sublime joy of paradise.
The digital humanities are a cultural occasion to exploit. Summing up, it's about merging humanistic disciplines with new technologies. I find this to be an innovating and modern tool to update culture. Cultural heritage becomes something to hand over to the new generations and not to be put aside. So it's about using technology, pixels, and binary code with a human and humanizing content.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
week it's been. From New York City this morning, trying to get you to the weekend. This is Bloomberg Surveillance alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Your equity market up 12 on the S&P, up 0.25% this morning. On the week, down about 1 percentage point. Potentially the biggest weekly loss coming back to early October. In the bond market, yields are higher on 10s by more than 10 basis points. On the week, on the session, by a single basis point to about 156, 155.96. Big move on 5s, big move on 2s. This whole curve has shifted higher off the back of that CPI print. And that CPI print, Lisa, has really brought to life the outlooks for next year. A 6 handle in America, making people rethink perhaps how aggressive this Fed might need to be.
And the fact that the inputs were widespread. Rent, what's going to bring that down? All indicators show that it probably will continue to increase. This is not just an energy story, and I think that was the main issue that kind of jolted people out of thinking that perhaps we are going to see a decline in these inflation prints.
The 2 words that jumped out for me, Tom, broader, stickier.
Yeah.
The inflation print, broader and stickier.
Yeah, I'll go with the phrases, but I think what I see in the literature and looking into the literature, frankly, for me, starting, I mentioned Kit Jukes, John, you mentioned, but I would go to JP Morgan tonight, their weekly prospects, and then on from there, including RBC Capital. And to me, the basic idea here is broader. That's what we're seeing. I really can't emphasize that enough. I did not expect that, John, and yet here it is.
Steve Englander of Standard Chartered, I thought, put it perfectly, Tom. It's as bad as it looks. And he added to this, if you take out the reopening story, and he stripped this out, I mentioned it yesterday, it's worth mentioning again, remove motor vehicle purchases, rentals, airfares, hotels, motels, all of that good stuff, and you still get 5.4% at an annualized pace and rising. And Tom, this is the issue for me. When we started the year, the transitory story was fairly intuitive. It made a lot of sense that we had these temporary factors forcing inflation higher. They would fade over the year and inflation would come back down. What's happened as the year has grown older, Tom, the story's got broader. And I'll use that word again. It's got stickier, so it's going to last longer, too, into next year.
The next 30 minutes for us are important. Damian Sassower will join us here in 15 minutes on Emerging Market. Really looking forward to that conversation. And right now, Thomas Porcelli, Chief U.S. Economist at RBC Capital Markets. Tom Porcelli, folks, definitive on wage growth in the study across our market economy. Tom, on wage growth in the new breadth of inflation, what's your x-axis look like? How has the timeline into next year changed on gaming a true, real wage growth?
So I think, so good morning, first of all. And sorry, I know I was supposed to be with you on TV, but my internet had some issues. Anyway, look, I think that what you need to keep in mind is, you know, we keep on hearing this idea about, you know, how the Phillips curve is flat, you know, i.e. it's broken. I think what you need to bear in mind is if you look at the Phillips curve in a more narrow way, right, just look at it in a couple of years before the pandemic hit, what you would actually see is that the Phillips curve was actually rather steep, right? In other words, you were generating inflationary pressure on the back of these tight labor markets where wage pressures were building. And, you know, I think, again, part of the conversation I think is getting lost in all this is that's where we're going, if by the way, we're not already there. So I think that, you know, the prospect for wage gains is solid. But again, I think we have to bear in mind we're obviously dealing with incredibly elevated inflation. So I think in real terms, yes, it's going to look pretty abysmal, I think, from a pure wage perspective in the immediate term. Wage pressures are inflationary pressure is going to slow. I mean, you know, that's long been a part of our call. Again, we've also long been part of our call has been that inflationary pressure would remain elevated much longer than I think was appreciated. But I think, you know, once you get into sort of 23, I think things probably look better from a real wage perspective.
Do they look better back to an atom posing 3%, or do you have a construct that we can actually disinflate back to a 2-ish% level?
Yeah, I think that's reasonable. I mean, look, you know, if you think about where we were from a wage dynamic perspective, and again, you know, here's where you know, it gets not tricky, but I think, you know, everyone has their you know, the wage measure that they prefer most. I mean, we like to look at the index of aggregate weekly payrolls, something we call the wage pie. You know, that thing prior to the downturn was running, you know, between 4 and 5%. So sure, I mean, you know, depending which measure of wages you prefer to use, I think you can easily have a sort of a robust, you know, sort of nominal or real, wage picture But again, it's and that's where the debate comes into, Tom. It's like, well, which measure do you want to use? There's at least a half a dozen good ones out there. I think this wage pie that we like to look at, I think that's probably a fair way to think of it. And in that terms, yeah, I think you can easily get to somewhere in the 2 to 3% range.
Tom, you put out a note about a month ago. I forget the title of the piece, but it was on inflation expectations. We get a read on that a little bit later this morning. Your bottom line conclusion was they matter. Can you walk through that, Tom? Why they do so much?
Sorry, Jonathan.
It was on inflation expectations. You put out a piece about a month or so ago. I forget the title of that piece. I'm sure you recall it. But the conclusion was inflation expectations matter. You were pushing back against some of the things we've heard more recently. Why is that, Tom?
Yeah. So look, I think if you think back over the last year or so, and I think the Fed owns some of this. Continuing to tell people, hey, don't worry about inflationary pressure. It's going to fade. People didn't necessarily take that to heart. I mean, so what you saw was inflation expectations really started to rise. And what's interesting is they really started to rise in April. And guess what really started to fall in April? Confidence. And more specifically, within the sort of the sphere of confidence, people's expectations or people's view on whether or not it was a good time to buy sort of bigger ticket items, that really started to collapse at the same time that rising inflation expectations started to rise. So I think you can easily lay claim to the idea that people were impacted by what was happening on the inflation front, and it showed up, and it showed up in the confidence data. You can look. Let's all be clear. It's very difficult to prove the counterfactual, but you can have a reasonable argument or discussion about, hey, well, should consumption have been much stronger? Again, and make no mistake, we had Delta that got in the way. We understand all of that, but it's pretty evident from the data that the consumer did feel the pinch of rising inflation, and it showed up in their expectations about buying things.
Tom, on a recent note, you said it doesn't matter who is at the top of the Fed next year, whether it's Lael Brainerd or whether it's the Chair Powell, they will have to respond more meaningfully. They cannot ignore what we're seeing on the inflationary front. What do you mean by responding? Because they are tapering. They do have plans to potentially reassess mid-year about the idea of raising rates. Do you think they're going to be more aggressive?
Yeah, Lisa. So it's a great question, and so we opened that daily deck with that comment, mostly because over the course of the prior couple of days, all we heard about was, hey, if Governor Brainerd, replaces Powell, she's going to be incredibly dovish. Look, there's still, unless they're changing this, there's still a dual mandate. And so our point was, it doesn't matter if it's someone perceived as very dovish or not, sitting at the top of the House of the Fed, that they would have to respond to this inflation dynamic that we're talking about. How forcefully, fine, that's a reasonable question / argument to have with folks. But in the inflation dynamic that we exist in today, with getting to max employment by next year, which, by the way, is not just our call, that's the Fed's call too. There would be no reasonable grounds to sit on the sidelines and not raise rates. So that was our bigger point there.
Tom,
sorry, Lisa, go ahead.
Fed officials have come out and they have said, look, these things will abate. They will naturally roll off. It is not our job to try to respond to supply chain disruptions. It is not our job to respond to commodity price increases. These are not things that we can control. What's your argument against that, of how they should move in response to some of these inflationary pressures that are within their control?
Well, and I think Jonathan sort of framed it perfectly right before I came on. There's already been a broadening out of inflation pressure. It's not just limited to the standard trope of, hey, it's all about the supply chain and about all the boats that are stuck out in in the bay. I think it's beyond that. I mean, there's an incredible amount of demand. The consumer is sitting on a mountain of cash up and down the income spectrum. And so it's now you're seeing this broadening out. We have something called the diffusion index, something we created, Cpi Diffusion Index. And if you look at the diffusion index, which is basically just a measure of the breadth of inflationary pressure, we've never seen it this high. So it's not just some sort of a few categories that are doing all the lifting here. There are a few categories that are responsible for lifting it very materially, but in terms of the breadth of inflation, that's expanded out now. I mean, look, services prices which is the bulk of inflationary pressure, or the biggest weight, of inflation. That's only starting to get going now, right? I mean, that's a shelter story for sure, as I think is appreciated, but that's also a medical care services story, right? I mean, again, I think, people love to talk about used cars and autos, and make no mistake, those are important things, particularly when they're outliers. But medical care services is also a significant weight, and that's only showing signs now of lifting. And we all know that a lot of medical care services weren't actually getting done in the midst of the pandemic. So that's yet another category that will continue to show, we think, significant upward pressure over the coming year or so. So it's not just about the Fed responding to sort of boats that can't make it into port.
Yeah.
It's about a more broadening out of these inflationary pressures beyond that.
Tom, super sharp, as always. Love catching up with you, buddy. Thank you for being with us. Tom Porcelli there of RBC Capital Markets on this inflation backdrop. Just as we get a headline on coffee, hitting a 7-year high as the global supply threats worsen. Tom, anyone who's been following the weather in Brazil and what's happened to coffee yields over there, not pretty.
Yeah, well, that's just one of the stories. And, I would really, to that point, John, and it'll be the visit I'm going to make with Vet Bill this weekend to the grocery store. And the bottom line is it's every single aisle. I really don't think we can center on oil. It's everything.
Coming up on the next hour, looking forward to catching up with Mohammed Al-Arian on this inflation story and on why he thinks we could be making one of the worst inflation calls in decades. He's 20 minutes away. Looking forward to it. From New York City, this is Bloomberg.
With the First Word News, I'm Rishka Gupta. Oil is heading for its longest run of weekly losses since March. President Biden is keeping investors guessing whether he'll intervene to hold down prices that have hurt consumers. The price of gasoline in the U.S. has hit a 7-year high. The president is considering a number of moves, including a release of oil from the Strategic Petroleum Reserve. Rivian Automotive has an extensive post-IPO to-do list. The electric vehicle company raised $12 billion earlier this week, and now it wants to build a standalone battery plant in addition to 2 new vehicle assembly factories that already were planned. Bloomberg's learned that Arizona, Michigan, and Texas are amongst the states being considered for the battery site. At the Climate Summit in Glasgow, talks on creating a global carbon market have run into some new obstacles. Countries disagree on how to account for emissions credits that get sold. Talks will continue today with less than 24 hours to go before the summit is set to wrap up. And it's one of the messiest spats amongst Democrats as they try to pass the tax and spending package, the state and local tax deduction known as SALT. Donald Trump put that $10,000 cap on it. Democrats from high-tax states want to expand it as part of President Biden's economic plan. Progressives are opposed, so some version of a SALT cap may remain. And Donald Trump has got a court win to shield his presidential diaries, call logs, and other records for now. A federal appeals has temporarily granted the former president's request to keep the documents from being released to a congressional committee investigating the Capitol riot. The court will hear arguments in the case November the 30th. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
Is there at the moment amongst the asset managers that actually some of the ESG labeled products, then if you probe, are not green?
Well, look, there is some stress, and it's great that there's that scrutiny, and there's that skepticism or healthy skepticism about ESG labels or sustainable labels. And that, again, is one of the reasons we're having this ruthless, relentless focus on net zero, because in the end, look, we can't stabilize the climate unless we get to net zero. And it's as simple, these are hard numbers. Your emissions are either A or B, they're going up or down. And if they're going down, are they going down consistent with the science? We anchor it in the science, the same science the UN and others use for the 1.5 degree objectives.
Should this not be compulsory? Should we not have regulators coming in and saying, look, this is a new definition, you stick by it, and we're going to measure it?
So I think it's a great question. So let's look at what happened with TCFD, climate disclosure. 6 years ago, you and I were in Paris. We talked about this. We talked of other things. Now that's moving to become mandatory.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The past 18 months have reminded us how essential the PC is to work, life, learning, and connecting. And with Windows 11, we have renewed sense of the role Windows plays in the world. It offers personal agency and real choice to users.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
We're already rotating some of our exposure that we have from the U.S. to emerging markets if we look at valuations, and anticipating further support, particularly out of the Chinese government. We think there's going to be an opportunity for these markets to pick up and make up a lot of the lost ground.
Daniel Morris of BNP Paribas with their theme on emerging market. And of course, the heritage of BNP Paribas is known particularly across the Pacific Rim, the decades and decades of experience they've had there. EM is front and center in the Great Reset for November, for December, into next year. Damien Sassower joins us right now. Damien, after Seema Shah is on, I need to go to you for a clinic on the coefficient that matters in EM calculus and algebra, I should say, and that is always, in every case, wither the dollar. How beholden is your world to weak dollar?
Yeah, no, absolutely. I mean, Tom, first things first, let's not rail on any of your previous guests. I mean, Seema Shah makes a great point about China, but that's for EM hard currency sovereign creditors. You know, if you're investing in EM dollar bonds, China's going to make some money for you for sure. Valuations have gotten absolutely crushed. It's probably the only game in town there now. But the dollar is what matters most. If you're a real practitioner and you're taking your dollars, you're moving them offshore into another currency. And from that perspective, very, very, very difficult to get bearish on the dollar in this environment. And so from that perspective, the only way to approach emerging market local currency assets, be it equities or debt, is to have a position on the dollar and perhaps to take more of an intra-EM approach, you know, to basically go long the rail versus short one of the funding currencies. We put out a great deck on that this morning.
Well, I'm sure you did. Lisa's working on her deck as well for the end of the year. Damien, I look at where we are with EM, and what it comes down to is having the courage to go in. How do you perceive the fragility? EM authorities will tell me, for example, at IMF, that they're better positioned now, more stronger, more resilient to the vicissitudes of the West. Do you buy it?
I really don't, Tom, and I'll tell you why. I mean, look, what they're going to point at is they're going to point at fundamentals like improving current account balances, right? Which admittedly have improved, but that's more of a remuneration kind of impact. You know, again, it's the fact that, you know, in dollar terms, their current account situations have improved. Doesn't mean their economies are any more healthy. And in fact, if you look at the total debt load, we're through the roof, right? We're at all-time highs on a hard and local currency debt perspective. And if you look at external debt ratios across the emerging market complex, Tom, I think 11 of the 20 majors have seen external debt ratios surge way more than their 5-year averages would indicate. And so from that perspective, it does give me considerable cause for concern.
Why haven't rate hikes in the emerging markets complex actually fought this dynamic?
Well, the inflation dynamic, I mean, the impulse is so persistent, Lisa. You know, you talk about that each and every day. In emerging markets, it's so much deeper. It's so much more intense. And so it's really difficult to get a handle on it. You know, I mean, look, anyone in their right mind would say on the move we've seen in the front end of these emerging markets, it'd be a great opportunity to kind of fade it and start receiving. And, you know, you're right. If you did that in Mexico overnight with the central bank obviously failing to deliver on a 50 bp hike, but you know, it's very idiosyncratic. And, you know, for me, what you really have to look at are these low-yielding funding currencies and the moves we've seen. I mean, you can't fund. I mean, they're forward markets, you know, going out to 1 or 3 months are no longer negative sloping. So you don't have that negative carry that you can feed on when you're funding an EM risk. And so it does make things a little bit more challenging. But that's what we're here to do here at Bloomberg Intelligence, to show you a better way. And so you have to read our research.
What is this, a sales pitch?
Damien, with your sales pitch, talk about the idea of China being the exception, not the rule when it comes to emerging markets. You said that you see opportunity there when it comes to making money in the dollar bonds even. And this comes at a time when there's growing defaults, there's growing concern about the weakness that we're seeing in the home developer space. Why is now a good time? Is it entirely because of likely easing by the People's Bank of China?
Yeah, no, it's not easing, actually. It's the relaxation of credit to the mortgage sector. I mean, we are seeing real evidence of that. Just in the last 24 hours, policy banks are boosting lending to the sector. A lot of the state-owned enterprises are pleading to Beijing, asking for better lending terms so that they could go out and acquire these troubled property managers like Evergrande, like Kaisa, and the rest. And so for me, it's that relaxation of credit on the mortgage sector, which should support valuations for China high yield, which, as we all know, is now yielding on average something on the order of 22, 23%. That's where the real value play is in EM hard currency credit. And so, again, to see Mashah this morning from PGI, yeah, that's probably the way you want to play it. But you got to, I mean, how much risk can you possibly take in that sector given all the uncertainties, right?
Damien, is there an opportunity in Eastern Europe, given the immediate politics of the moment? Like, can you play ruble?
Ooh, ruble's tough after what we just are seeing here over the last 24 hours in terms of gas and Gazprom and Rosneft and Belarus and everything that we're seeing there. The way I'd prefer to play Eastern Europe is through the CE3 or 4 if you include Romania. That'd be Poland, Czech, and Hungary. What we're seeing there is real inflation. And, you know, along the periphery, what we've seen are yields on a local level really climb in the last few months, Tom. That's a real opportunity. Those economies are relatively stable and safe. Yeah, I'd be carrying in those economies.
Damien, we don't care. We only had you on to talk about NFL football this weekend. What's the game I and Lisa should watch?
Well, you don't want to be watching the Jets-Bills game like I'll be, unfortunately. That would be an exercise in futility. But, I mean, look, you know, I definitely think, I don't know. I mean, like, I lost Derrick Henry in my fantasy football league, so I've been in a real bad place for the better part of the last 2 weeks.
Yes,
so,
we've heard.
You know, it's anyone's guess.
We've heard you mortgage.
I'll be watching them all. I'll be watching the Red Zone.
Okay, very good. What I know is Damien mortgaged his son to keep the fantasy football league going. Damien Sassauer, thank you so much. Bloomberg Intelligence. Lisa, you know, we laugh about it, but Paul Sweeney has told me it has been a bang-up season for the NFL. They are just killing it.
Are you really trying to get me to talk about football?
No, I don't care about the football, but I care about the entertainment.
All right.
No, after Disney this week, I think there's a real mystery out there, Lisa, about where this is going post-pandemic.
The idea that they've had a shrinking audience audience for a while, and that young people are not watching football and baseball, they're watching other people play video games, and that's actually a more prevalent and growing area than anything else. It defies logic to me because I didn't grow up that way, but my kids try to give me tutorials about it all the time.
It's just so much on there. I mean, I just think it's just extraordinary. Lisa, let's sum up here. You know, we're making jokes about you putting a deck together as thick as Mary Meeker's and all that next year, but the mystery now in this humbling time is frankly greater than the mystery 12 months ago.
But the mystery around the economy, not necessarily the mystery around markets. And this, to me, is the interesting distinction. If we accept this idea that real yields are going to remain this low, there is no other game in town other than equities. This is the argument that we're hearing again and again. Where does that leave the bears? Where does that leave the contrarians who don't want to go there because they see weakness and they see slowing growth? This, to me, is a key conundrum in 2022.
I go back to our first interview of the morning, folks, with Christopher Verone, a strategist, who makes it real clear. You look at the sum total of fundamentals and the technical work that he does, and Lisa, he is optimistic. He says the construction is there for a better market.
People are generally optimistic about the market, even as they see potential deceleration in growth. And this is the differential to parse through.
Is Farrell going to ask Elarian about Jets Bills? I mean, is that on the docket here in the
Maybe
next
you
hour?
can make a surprise appearance. I'm sure he'd love that. You should just show up to the set.
On the transaction of the day, Johnson & Johnson to separate their chief executive officer, Alex Gorski, at 10:15.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
From New York City.
In London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. So recap the headlines.
You do not want to miss this story.
How are you thinking about those dynamics?
Isn't it just how
sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Let's wrap up the trading week from New York City for our audience worldwide. Good morning, good morning. Your equity market positive, 0.25%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
From New York, we begin with the big issue, hotter for longer.
These inflation numbers are bonkers high.
Persistently high.
Getting worse before it gets better.
Now we're starting to see how corporate America is going to adapt.
Do the supply chain issues and the participation rate get resolved in 2022 or not?
I'm very concerned about kind of the shape of the curve and the Fed's ability to manage the shape of the curve in the near term.
It's very hard to argue that these conditions are going to be true a year from now.
The key question here is whether this inflation print is going to translate into higher inflation expectations.
The central banks are stuck on hold. They're buying bonds. They're going to wait until the middle of next year. They're going to wait until the dust settles.
Is this going to change the Fed's course in terms of taper? No.
There are things going on in the global economy that we've never seen before.
We get lucky this morning. We're joined now by Mohammed Al-Arian of Bloomberg Opinion and, of course, of Queen's College, Cambridge. Mohammed, thank you for making the time for us this morning. You wrote a scathing piece in the Financial Times this week. I want to start with a quote from it. Failure to act promptly would turn the Fed's increasingly discredited transitory characterization from one of the worst inflation calls in decades to also a big policy mistake with widespread and unnecessary damage. Mohammed, I want to start with that single piece there. One of the worst inflation calls in decades. Why do you think it's this bad?
Because they didn't show humility at the beginning of the process, and that's something that you and I talked about. There are lots of structural changes going on in the post-pandemic economy, even though we're not quite there, but post-immediate shock. You can't simply dismiss them as transitory. You've got to respect the fact that behaviors change. And they just didn't have the open mindset enough to see that. So they got stuck in this narrative, and they held on to it for too long. And the result of which is they're looking at inflation that is much higher than they ever expected. They're looking at inflation that's much broader than they expected. And they're looking at inflation that's going to last even longer than they expect even now. So it is going to go down in history as one of the worst inflation calls by the Federal Reserve.
Well, let's work through the incoming data. Mohammed, what is it about the incoming data that's making you more confident of this call, not less?
So, John, I've been confident of this call for a while because I talked to lots of companies. And you clearly see what's going on from a bottom-up perspective. Wages are going up. Prices are going up. Expectations are that supply chain disruptions and labor shortages will last into next year. And there is confidence that pricing power remains. So put all these things together and you get this cost-push inflation. There's also a demand-pull inflation component in it. So when you put all these things together, you've got to respect the probability that inflation will remain high and will persist for much longer than most people expected.
Mohammed, what do you think it would take to change the minds of people that disagree with you? I asked Vice Chair Rich Clarida earlier this year, what would be the tell? How would he know that he might be wrong? And he would say it would be the turn of the year. This is what he said earlier this year. He said the turn of the year will get a better idea of how temporary these factors are. The turn of the year is right in front of us right now, and I don't hear this Federal Reserve changing their mind or pivoting anytime soon. What do you think it would take?
So I think the Vice Chair, in his latest remarks, did show a little bit of acknowledgement that inflation is well above what he expected. And what will it take? It will take a few more prints. It will take labor force participation not bouncing back as fast as we all wanted to. To be clear, I want to be wrong on this call. I desperately want to be wrong on this call because if inflation ends up to be hotter for longer, it has very unfortunate economic, financial, institutional, social, and political implications. So we all want to be wrong on this call, and we all hope that inflation is going to come down very quickly, very soon, but I don't think that's going to happen, John.
You're making two calls here. One, this is the worst inflation call in decades. You think we're already there. That sounds like a conclusion to me. The next call is that we could make the biggest policy mistake. Now, it's the policy mistake that you don't think we've made as yet. You think the window, though, is closing. How big do you think the window is?
It's small. It was wide open when you and I started talking about this in March and April. The economy was doing extremely well. That was the time they should have started tapering. They didn't. Now they're going to start tapering, and the concern is that the time between ending the taper and interest rate hikes is not going to be significant. In fact, they may even overlap. Look at how the Bank of England is thinking right now. And in addition, they're going to have to raise rates much faster than they would have otherwise. That's the policy mistake, that you could have eased your foot off the accelerator, but you didn't. And now you're going to start tapping the brakes at a time when there will be 3 other contractionary impulses on this economy. That's what the policy mistake would look like, John. I hope it doesn't happen. There's still a window to avoid it, and it would start in December by the Fed accelerating its taper program.
Why do you think accelerating the taper would make a difference, Mohammed? Within the piece, you acknowledge the supply chain bottlenecks which have contributed to elevated inflation, although we can both acknowledge, as sitting here, that it's not just that. Why do you think accelerating the taper would make a difference?
Because initial conditions matter. When you set policy, you've got to know where you're starting from. And we are starting from emergency level monetary policy at a time when the immediate emergency has passed. So if we continue with this pedal to the metal approach to monetary policy, we are going to destabilize inflation expectations. And if we destabilize them in a serious manner, then we're going to have an additional layer of inflation driver in the mix. So we want to limit it right now to demand pull, which will come down with time, cost push, which will come down, but at a slower pace over time. The last thing you want to do is add a third one, which is a fundamental de-anchoring of inflation expectation. It is the Fed's responsibility to ensure that it doesn't destabilize inflation expectation.
What this seems to come down to is a disagreement on what it would take to have a sustainable recovery that leads to the objectives that you want to achieve and the Federal Reserve want to achieve as well, Mohammed. What I've witnessed this week is an acceleration of the calls that speak to what you're talking about. More rate hikes next year, 2 from Wells Fargo, Bank of America looking for more of the same. Wells Fargo put out a call, though, along with that rate hike call this morning, Mohammed, that I thought was interesting. They're looking for 5% CPI next year, on an annual basis 5.2, but real GDP growth with a 4 handle. This is where I want to understand from your perspective, Mohammed. Are you looking for elevated CPI through next year that hurts growth, or can we still achieve real GDP of something north of 4%?
So we can achieve high GDP. We have to achieve high GDP. Also, we have to make sure that the most vulnerable segments of our society don't suffer because of inflation. Remember, inflation taxes the poor the most. So this is doable, John. Policy-wise, this is doable. I want to stress there is a window. Yes, you can have relatively stable inflation and you can have satisfactory economic growth. But the concern I have is the following, is that not only are we going to have lower growth than we would have otherwise because the Fed is going to be late and then it's going to have to overcompensate, but in addition, we risk in the risk scenario, I want to stress the risk scenario, the following configuration in the middle of next year. Monetary tightening, financial conditions tightening, household tightening because savings have been eroded, and fiscal policy impulse dying down. And that would be tragic if we inadvertently end up creating these 4 headwinds to our economy.
And you know why some people disagree with you, Mohammed? They look at the last cycle and they say we should have been more patient. They've been conditioned by their experience for the previous 10 years. They're applying it to this cycle. I think that's where we need to finish, Mohammed. Why is this cycle for you this environment right now so different to what we experienced 10 years ago, and why the conclusions from the previous cycle not applicable to what we're witnessing at the moment and for the years to come?
Because the prior cycle was characterized by deficient aggregate demand. The problem was demand, was not supply. This cycle is characterized by deficient aggregate supply. Demand has been bolstered by massive inflows of liquidity directly and indirectly, and by all sorts of fiscal transfers. The problem is not demand right now. Overall, there are segments, the most vulnerable, again, where there is a problem. But overall, the problem is deficient aggregate supply. And the problem in the community is people's mindset is still anchored by deficient aggregate demand. I've seen it before, John, coming out of the global financial crisis, when my PIMCO colleague and I were saying, be careful, this is a new normal. These are secular forces in play. We were dismissed by all those who had just a cyclical mindset. It took 4 years for that mindset to change, and we lost a golden opportunity to maintain living standards.
Mohammed, I know you've been busy over the last couple of days. We appreciate you taking some time out for us this morning. Thank you, sir. Mohammed Al-Aaron of Queen's College, Cambridge, and of course of Bloomberg Opinion. Your equity market positive about 1/3 of 1% on the S&P. There's a single mover pre-market I want to pick up on. It's J&J with some more. Here's Abby.
John, it certainly is the big story this morning. The news that J&J is breaking into 2 separate companies. The age of the big company seems to be disappearing with J&J joining GE. They are planning to break into a drug and a med tech company on the one hand, and then a consumer company on the other hand. Shares reacting in a very positive way, up 3% right now in the pre-market. Now, relative to the growth, it's all about drugs and med tech. Very positive for pharmaceutical, about 14% year over year growth in the third quarter. Med tech up 8%. In addition, that's the bulk of the revenue, about 85% of the revenue for the company. Relative to that consumer unit growing just 4.1%. And not only that, but there's lots of litigation there around talc, opioids. So in the last couple of years, we have seen legal costs for this segment really grow into the billions of dollars. So if this happens, it plans to happen within the next 18 to 24 months, you're really going to have the high growth drug and med tech unit, and then the slower growing consumer unit. And then, John, we also have a bit of breaking news, if I may, which is the AP is reporting that President Biden has picked Robert Khalif for FDA Commissioner, Food and Drug Administrator. He served for President Obama back in the day, so sticking with the healthcare theme there.
Abby, thank you. Looking forward to more coverage through the day on Bloomberg TV and on Bloomberg Radio. Your equity market advancing 1/3 of 1%. This is the big debate right now. You've heard the one side from Mohammed. You'll hear the other from the Federal Reserve. Coming up, why the Fed is staying the course.
Inflation is higher. It's eye-popping. This is a transitory period. That's what we believe. That's what I think when I look out at the data. But it's directly related to COVID. And as quicker we get through COVID, the better off we're going to be as an economy.
The hottest print in 3 decades. Weighing in, State Street's Gaurav Malik, Charles Schwab's Colin Martin, and Lisa Hornby of Schroders. They join us next from New York. This is Bloomberg.
Common ground on energy that you share now with the Prime Minister of the United Kingdom?
We are both very committed to the transition to a net zero future, and as part of that, to building up the renewable energy capacity for Scotland and the UK. Scotland has got massive potential in wind energy in particular, onshore and offshore, but also some real potential in new and emerging technologies, carbon capture and storage, for example. There's also, I think, an understanding, and perhaps the UK government and I don't entirely agree on the detail of this, but we must accelerate the move away from fossil fuels. We've got to do that carefully in a way that protects the people who are currently employed in that sector in Scotland, around 100,000 jobs, and do it in a way that doesn't see us importing more oil and gas, but instead moving to the alternatives.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Inflation that is much higher than they ever expected. They're looking at inflation that's much broader than they expected. And they're looking at inflation that's going to last even longer than they expect even now. So it is going to go down in history as one of the worst inflation calls by the Federal Reserve.
Mohamed Al-Arian not mincing words over the Fed's inflation call. PGIM's Robert Tibbs saying the changing dynamics are forcing investors to stay nimble.
The best cure for maintaining purchasing power and beating inflation is not staying in cash. It's not staying in the richest sector of the fixed income market, which is Treasury tips. It's being out in a full market exposure and looking for opportunities to add value on the back end of the curve. Trying to time this market, is incredibly dangerous.
For more, let's get back to Abby. Hey, Abby.
Hey, John. Well, very interesting comments there from Robert Tipp in terms of the idea of staying nimble in this ever-changing scenario around inflation. Not so long ago, folks weren't worried about it. Now it's all we can talk about, and it seems that most people think it's not transitory. And if we take a look at the S&P 500 earnings yield adjusted for inflation, it would seem to agree. We are at a record low, less than 2%, negative 2% earnings yield for the S&P 500. Inflation really eating into it. It's not so long ago that was actually above the 10-year yield. And in terms of sectors that are super sensitive, of course, it's all about the growth sectors. Consumer discretionary and technology, both very, very rich already, trading at about 25 times or more the forward estimate. If inflation becomes a continued concern, it will eat in even more. In terms of inflation, take a look at that 2-year yield over the last month, up 17 basis points. That's that eye-popping, another way of using eye-popping. And you can see that benefiting both the new form of inflation hedging and the old. Bitcoin up 16% and gold up 5.5%. Inflation does seem to be here to stay, John.
Abby, thank you. Joining us now to discuss is State Street's Gaurav Malik, Charles Schwab's Colin Martin, Lisa Hornby of Schroders. Lisa, let's start right now with this market at the moment. Where do I go if I want to hide right now? If I believe inflation is the risk and there's some risk in the perceived risk-free asset, where do I go for those risk mitigation characteristics at the moment?
That's a good question. Yeah, fixed income markets are challenging. There's nothing that you can look at today and say valuations are overly compelling. Our focus right now is sort of the intermediate part of the corporate markets. I think there's still a little bit of carry that can be generated by investing in high quality corporates or some of the more cyclical issuers as well that will continue to benefit from the economic recovery. But the challenge, as you highlighted or alluded to, John, is the fact that real yields are very, very negative. And that's true across the vast majority of the fixed income market. So it's a challenging one at the moment. And I think the reality is that it's going to stay that way for at least the next few months. But I think that volatility that will come probably in the middle of next year, if our expectations are correct, will give us a little bit more opportunity.
We'll work through that call in just a moment. Gaurav, I spoke to Goldman Sachs about an hour ago, Christian Muller-Glissman, who pointed out that for him, he'd rather be in cash than bonds. Does that resonate with you at all?
Yeah, I think we do like cash the way it stands today. We also do like shorter duration, lower credit. I think there is still some value there. I would agree the intermediate part of the corporate curve is pretty good. But as we look at the inflation question and look at other assets, for us, equities is still a good place to be. And within that, we're sort of finding up a bit more on European equities, which do have a bit more exposure to those cyclical segments of the market that are likely to benefit from this inflation trend.
I want to break down on that European call in just a moment because Bank of America are out this morning with a really punchy quote note on that a little bit earlier this morning. Colin, I want to work with you on not just the CPI call, but on the GDP call as well. Wells Fargo are looking for a 5 handle on CPI next year, but for an equity investor, for anyone long risk assets, if I can promise you real GDP of 4 next year as well, are you comfortable still having that exposure to risk, Colin?
We are. I mean, we think the outlook is still pretty strong right now. We're getting a little bit more cautious on the junkiest parts of the market, mainly just because of valuations. If you look in the broad fixed income markets where junk bond yields and spreads are, they're historically low, and we are a little bit concerned about what the potential for sooner than expected Fed hikes can do and what a flattening yield curve might do. But if you look at just the fundamental outlook, like you alluded to, strong growth, strong corporate profits, tons of liquid assets on corporate balance sheets, we're still okay taking risk. We're not telling our investors and our clients to run for the hills in the junkiest parts of the market just yet, but you do want to be a bit nimble, and it's something to be concerned about a little bit as we probably approach the middle half of next year.
Lisa, you mentioned that elevated volatility you're looking for the middle of next year. What's the source of that?
I think it's a few things. You know, when we look at the economic data for the next couple of months, we think it's very, very strong. But when you get forward into particularly around Q2 times, the comps get a little bit more challenging. We're also going to be faced with the reality of withdrawal of liquidity that seems to be happening globally. Of course, the Fed is reducing its asset purchase program. It will be complete by the end of next year, middle of next year, and we'll be looking at rate hikes, I think, very shortly after that. So this withdrawal of liquidity is really the rising tide that has lifted all ships over the last 18 months. I think that will be a challenge. We potentially have a little bit of a fiscal cliff coming middle to end of next year as well, depending on how the most recent infrastructure package gets deployed. So I do think that there are more challenges as we head into Q2, Q3 of 22 than we're currently facing now. And I think liquidity is probably the main driver of that volatility.
And let's talk regionally, where those challenges might be, not just the US, but also in Europe. Gaurav, you talked about the European equity exposure that you want to see. This came from Bank of America this morning. We expect the anti-Goldilocks combination of weakening growth momentum and rising real bond yields to weigh on European equities with a projected 10% plus downside by early next year. Gaurav, that's just one view. It's a market. We need yours too. Why do you push back against that?
Well, I would say still, I mean, you think about all the conversation we've had just recently about commodities, about inflation, supply chain bottlenecks. All those are areas where Europe has an advantage. As we go through and as we see investments occurring on the fiscal stimulus side, those do benefit European industrial sector firms, materials, energy. We see oil as being range bound, so we don't see oil dropping off too dramatically, which again benefits European companies. The other side of it, though, is also the fact that we are actually quite excited about NGEU. So we do think this is a real genuine chance for there to be a structural shift occurring in European growth. And we won't see the effect of that till the latter half, which means now's the time to build the positions as we position those benefits coming through.
Attitudes to European equities just haven't shifted. If I asked you to guess where European equities were year to date on the Stock 600, how many people would say up about 22%? But that's where we are on the Stock 600 right now. Equity futures at the moment, going into the opening bell, up a third of 1% on the S&P 500. Your opening bell about 7 minutes away. Gaurav Malik, Colin Martin, Lisa Hornby sticking with us. Coming up on the programme, the morning calls and later. Earnings season heating back up with some of the world's largest retailers reporting results next week. That conversation just around the corner from New York City this morning. Good morning. This is Bloomberg.
His top spot as Asia's busiest airport in 2020 when passenger traffic slumped 88% from 2019. The the lack of a domestic market and strict COVID rules have made for a slow recovery. And walking through the airport, the majority of F&B outlets and shops do remain closed. Here in the departure hall, long stretches still remain boarded up in areas where you would typically see throngs of passengers waiting to board their flights to destinations across the world. Only 2 lounges do remain open to travelers, one operated by the Plaza Premium Group and the other by Cathay Pacific, down from the 12 that are usually open here at the airport.
Unfortunately, when COVID had hit, we had closed a lot of our lounges and airport hospitality services. We're cautiously optimistic with the growth.
COVID certainly has forced a rethink of strategy to be nimble in the face of policy uncertainty during the pandemic era.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
We're staring right down the barrel of the biggest weekly loss since early October. We can do something about that. Equity futures are up about 1/3 of 1% going into the opening bell. We could take a bite out of that move. On the Russell, up 1/3. On the Nasdaq, up 1/3. That's the price action. Let's get you some morning calls. And we begin first up with Goldman Sachs downgrading HB Enterprise to a sell. The analyst expecting a weaker US IT spending environment throughout the rest of the year. That stock is negative 4.3%. Your second call comes from Wedbush downgrading NVIDIA to neutral, a $300 price target. The analyst cited the stock's valuation after jumping 50% from its October lows. That stock at 301 and negative about 1%. And your third and final call from Deutsche Bank, upgrading Penn National to a hold. The analyst expecting shares to catch up with its peers after massively underperforming as of late. That stock is positive this morning by 0.5%. From New York, coming up, a host of retailers reporting earnings next week, offering details about supply chain disruptions and the health of the US consumer. That conversation just around the corner, as is the opening bell this Friday morning. That's next. This is Bloomberg.
The past 18 months have reminded us how essential the PC is to work, life, learning, and connecting. And with Windows 11, we have renewed sense of the role Windows plays in the world. It offers personal agency and real choice to users.
Talking about Bloomberg surveillance.
There's some guy out on Twitter who says I look like I'm 101.
I know, I noticed that.
Do you think I need a lift? Is it time
that I... What did he say about me? What did that particular gentleman say about... Let's have a look. One of them is near 101 years of age.
Which one would that be?
The other has an ego in the orbit of Mars. Who's that?
I have no idea.
Mrs. Lisa, the only chance to productive conversation. It's a fairly accurate summary of this show, isn't it, Tom?
The eyes, or should I do the whole thing?
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This week has flown by. From New York City this Friday morning, good morning to you all. About 20 seconds away from the opening bell, the state of play as follows. Up a third of 1% on the S&P 500, advancing 13 points, heading for a weekly loss. We can take a bite out of that around the opening bell. NASDAQ futures up about a third of 1%. That's the opening bell. Switch up the board and get to the bond market. What a move this week on 10s. Yields higher by 10 basis points from Friday to this Friday. 155.28 right now. Unchanged on the session at the moment after being higher a little bit earlier. In the FX market, euro dollar 114.41, negative there, a tenth of 1%. Kit Juice of SocGen out a little bit earlier this morning, saying the US faces a bigger and more demand-led inflation spike that cries out for tighter monetary policy. Europe, put simply, does not. The euro will fall. That's the call from SocGen's Kit Juice, 114.40 on euro dollar. Crude 80.59, we're down about $1. We're negative 1.23%. We slide now for a third straight week on WTI crude. Look out for that. 80.60 on WTI crude. Around the opening bell then, this is the story for you on the S&P 500, advancing just a little bit by a quarter of 1%. The sector price action in the early part of the session looks like this. Communication names up by a half of 1%. Energy slides 0.6 of 1%. Bottom of the pile is energy, top of the pile, the communication story. Healthcare up 0.4, information technology also up by 0.4 of 1%. Back with us, I'm pleased to say, is Gaurav Malik, Colin Martin, Lisa Hornby. Gaurav, I know you've pulled back a little bit on large cap stocks here in the United States. Can you walk me through why?
A couple of reasons. One is that we use that partly to fund our position in Europe. And if you think about the performance of US over the last 5 years, it's always been an earnings story. US earnings have been much better than European earnings. And now we're at a point in time where European earnings, as we look at over the next couple of years, look just as strong, but there's a big gap in performance and valuation. So we liked Europe from a valuation standpoint. So we cut back a bit on US, which continues to be expensive. I would say still biased towards owning equities relative to where bond yields are, but in a relative context, still expensive relative to that. So we used it partly to fund that trade in Europe and partly to build up some hedges against inflation in real assets.
Just help me work through the US call just a little bit more, Gaurav. Where did you trim specifically?
It was a broad call across market. So there was no sector-specific call made within that. It was broadly just everything that we have across the board. In terms of where we are overweight right now, we still do like parts of tech. We do like the semi-sector. We do like some of the cyclicals in banks and materials. So still holding positions in those areas at the expense of places like staples, utilities as being the two large underweights that we have.
Gaurav, you mentioned you use that as a funding source for two things. European equities, one, and a little bit more of inflation protection, I think is what you said as well. Is the European call part of that same story? Is it two separate stories? Which one is it?
So it's a part of that story. There's a valuation hedge, and as I was saying earlier, that it gives us some more play into the cyclical segments that are likely to benefit from the inflation call. So part of it. The rest is, of course, in real assets, which is we see as a direct hedge against inflation.
The reason I raised that question, Lisa Hornby, Colin Martin, is how expensive inflation protection is right now in the bond market. Lisa, where'd you go for it?
I think you're actually best placed to look at a couple of areas. Commodity-sensitive issuers, and actually some of the emerging market issuers are starting to look a little bit more attractive from a valuation perspective. So I think you can actually start to layer some of those, particularly EM, into your portfolio for a bit of an inflation hedge. I mean, our EM team is very, very bullish on countries like Russia. I think there's other ones as well that are starting to open a little bit of value, particularly those that are geared to the U.S. economic recovery. So that's one area to look. The other, as I mentioned, is the commodity-related issuers. So energy space, materials, and mining. I think that there is some value in some pockets there, but that's. The opportunities are obviously much more limited than they have been any time in the last 18 months or so.
And for good reason as well, given where inflation is right now. Colin Martin, what's your response to that?
Well, we keep it simple, and if you want inflation protection, I think you can still just look at the TIPS market. We understand that valuations are at historically rich levels, and you might ask, why would we be interested in the 10-year TIPS, 10-year real yield at negative 115 basis points? Well, if you look at the nominal market of 1.5%, and we're seeing inflation readings of 6% plus, that's a negative 4.5% real yield. Now, of course, we don't know what future inflation will be, how long it will stay elevated. But as the whole, the program this morning and a lot of the various commentators out there discussing that, it seems like inflation will be here to stay for likely longer than expected. So yes, negative 115 basis points doesn't seem too attractive in a historical sense. But if you really do want that inflation protection, we think that it's worth considering, especially given the other alternatives in the nominal market.
In absolute terms, it is brutally expensive, but to your point, Colin, it depends what your forecast is. It's relative to where you expect inflation to go from here. I want to pick out a single name, J&J, announcing that split a little bit earlier this morning. About 5 minutes into the session, we are positive by 1.8% off the highs. Pre-market at one point, we were higher by about 5% or so. So that name, positive 1.7% or so. We'll catch up with the CEO in the next hour on Bloomberg TV and on Bloomberg Radio. Looking forward to seeing what he's got to say on what's behind this move. Elsewhere, looking ahead to next week, you're going to hear a lot about supply chains with the retailers reporting. We've already heard a lot about supply chains this week when we heard from the Union Pacific CEO. Take a listen.
It's going to take a while to dig out of the hole we're in, and it's mostly about getting labor into jobs. We need more truckers. We need more warehouse workers. We just need to be more fluid so that we can match supply of capacity with demand from consumers.
Abby, this is going to be a big story next week.
It is certainly going to be a big story, maybe the biggest story next week, as we have many companies reporting earnings in the retail space just days before Black Friday and the all-important holiday shopping season. I'm talking about Home Depot, Walmart, Lowe's, Target, TJ Maxx, even smaller companies such as Kohl's and Williams-Sonoma, Bed Bath & Beyond. What will these companies be saying about those supply chain disruptions? We will get to hear, plus around labor shortages and rising costs. As for the consumer, because we're also going to get to hear about the state and the health of the consumer, there's good reason to think that we have seen peak discretionary spending. Not surprisingly, in the first quarter of this year, growth 20%. In the second quarter, 38% growth on a year-over-year basis. Easy comps coming out of the pandemic. Nonetheless, we are estimated for pretty healthy spending in double digits in the third and fourth quarter of about 10%. However, will folks be able to spend on nice-to-haves? Because they're certainly going to be spending on the need-to-haves. Gasoline up 50% on a year-over-year basis. Utility gas up 28%. Used cars 26%. Food 5%. So again, the question of will consumers be able to spend on the nice-to-have if they're spending so much on the need-to-have, plus those supply chain snarls and disruptions. What will we learn next week? It's going to be all about retail, John.
Abby, thank you. Thank you very much. I want to keep coming back to home base. Despite everything we're talking about, this equity market year to date is up 24% on the S&P 500. As my good friend and colleague has said all year, Tom Keene, corporate America keeps adapting. That was the message from Woody Caesar of Credit Sites.
We're going to see a few more quarters of pretty strong and sticky inflation. But the reality is you should never underestimate corporate America's ability to adapt to new environments. We've seen that over the past 18 months with adapting to the pandemic. And now we're starting to see how corporate America is going to adapt to this new inflationary environment.
Lisa, margins have held up. It's been a story of resilience all year. Can we keep repeating the act? That's the question I keep leaning on. Do you think we can?
To some degree, yeah. I mean, margins are high. I think our expectation is they will come off to some degree, but they remain extraordinarily strong. You know, it really does depend on the inflation outlook. And from where we're standing, we see inflation peaking around February or March. So we're getting close to that kind of peak inflation narrative. Certainly we're in it right now. I mean, you look at the Google search trends for the word inflation and it's off the charts. Everybody's talking about it. Everybody's worried about it. Biden was out obviously earlier this week. If we're right and we do get somewhat of an easing in that peak inflation narrative, then I do think that those margins can remain pretty elevated and corporates can continue to do well from a fundamental perspective going forward.
As you point out, there's two outs here. Either these forces fade or there's more to push here, there's more consumer price tolerance. This is what Bank of America had to say. While consumers were able to enjoy very strong purchasing power since the pandemic started, it has recently shifted. This is not because of a lack of income support, but because more of that income is forced to go to higher prices. Colin Martin, that's the question for you, sir. Just how much consumer price tolerance is out there still?
That remains to be seen. I mean, prices keep rising, and we're kind of seeing it in a lot of our day-to-day, just daily purchases and activities. But consumers are in pretty good shape. I think that's important. There's still a lot of stimulus that's in there. If we go back to studies about what consumers and households did with their stimulus, a lot of it was savings and paying down debt, which means there's a lot of buying power still out there. So I think as the economy continues to open up and we continue to expect strong growth, I think the consumer will continue to spend, and that can help keep growth elevated. So for now, we think it can continue to be an engine.
Gaurav, can I get a final word from you on that, please, sir?
Yeah, I mean, I would agree with everything that's been said. I would say that you need to look at just this earnings season. 65% of the companies raised their guidance. I think there's little room for multiple expansion, but as you look at the other two levers for stock market returns, earnings, dividends, buybacks, those look really solid. So I don't see any room for multiples to expand, but the other two should drive for high single-digit returns for equities as we look at it next year.
The equity market's still sitting pretty in and around all-time highs, despite this conversation, which has dominated the debate throughout much of this year. Gaurav, great to catch up, sir. Come back soon. Gaurav Malik there, Colin Martin, Lisa Hornby. Coming up on this program, the big debate on the Federal Reserve, the difference between Fed Chair Jay Powell and Governor Brainerd.
It seems to be a debate between a known dove and a known very dove.
Just how big is that difference? We'll continue that conversation next. From New York, this is Bloomberg. I was just finishing what you were saying, Tom. November 3rd is when the decision is. Just in case people got confused, I will. Just one more story, Tom.
Yeah, thank God for that.
We're at 1:37 right now. Into weakness. Is this where they play the music in the Academy Awards? Is this it? Do I thank my mum again? Are you in charge of this?
Is she the only one?
Kill the music. You know who's in charge here.
Проходим опасный участок, ответственный. Устам поднимает тебя на жмаре. Шерпа страхует.
Очень много думал о том, что я сделал, и понял, что сделал какую-то нереальную вещь. Не знаю. Я до конца внутри себя даже не могу поверить, что я через это прошел. Состояние, наверное, организм истощен, потому что очень много физической работы. Своим вот этим поступком хотел сказать, что только через действие в этой жизни достичь можно абсолютно всего.
It's such an
interesting new world.
The world is changing.
For us, it's not about being first, it's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
It is really still day one for AWS and for our customers. It is still so early in this business.
It's more about his or her communication skills than about their view about monetary policy.
We're looking at a Fed governor who is ultimately going to be accommodative and is going to be very steady as we go.
It's not so decisive who is the chair.
Certainly we still see the Fed following a fairly dovish tack here, regardless of who's at the helm.
So far, tumbleweed. We're waiting for the president to announce the next Fed chair. Bank Lombard ODA's Sami Char weighing in on the potential reshuffle.
There are many other seats to be filled at the Fed. So Powell, or maybe later on Brainard, can actually reshape the Fed for the long run. If you reshape the Fed, it is going to give credit to its new framework, average inflation targeting, which means that the Fed will be patient in the face of inflation, at least until we have clear sign that we're at full employment. So clearly, the reshaping of the Fed is a very significant story for 2022.
A very significant story for next year. And of course, the next Fed chair, Anne-Marie Hordern, might be the current Fed chair. Right now, though, Anne-Marie, we don't know.
Yeah, we certainly don't, and we're still waiting. One thing we do know that developed, Jonathan, overnight is that what we're hearing from White House officials and these advisors who are part of this decision is that, remember those stock trades from that index fund that we learned about Jay Powell moving? It was during a blackout. It wasn't during a blackout period. It was above bar. But what we are hearing is that at the moment is not an impediment to him getting the top role. There are some that support Governor Brainard in the administration who are flagging this as a possible issue. But right now, White House advisors don't think it's a big deal. Doesn't mean they're leaning towards Chairman Powell. It just means that this is something that's not going to be a hurdle for him to be reappointed. But we should note that Republican Senator Pat Toomey actually used this episode to support Governor Powell. He says this raises questions about the operations of the Committee on Federal Reserve Bank Affairs. That, of course, is chaired by Governor Brainard, and he says is directly responsible for overseeing the Fed regional banks and their presidents. So you see a lot of Republicans coming out and supporting this reappointment of Governor Powell, Chair Powell. The issue, of course, is the timing. They have to go through a Senate confirmation, and there's about 15 working days left for the House and the Senate, Jonathan.
And this is a contentious decision as well. Anne-Marie, of all the reporting you've done, why are they dragging their feet on this?
It's a great question. He does have time. This is the issue. The president does have time. The reappointment has to happen by February. There are a lot of other issues the administration is facing. They wanted to get this hard infrastructure package over the line. They're working on their Build Back Better agenda. There's other issues that are rising as well. They're going to have a meeting next week, the President Biden with his counterpart of China, Xi Jinping. And there's not just this seat open. There are 3 others, depending if they reappoint Powell. If they don't, then that's 4 new people. And they want to come out and likely reshape what the Federal Reserve looks like and likely a little bit more progressive.
Has that inflation print made things more or less complicated?
I would say it's going to make things a lot more complicated for the administration. It probably would have been easier had they made this decision and then the inflation print comes out. But now everyone is going to view their decisions based on this immediate economic crisis that they need to speak to, which is, of course, higher consumer prices.
Rightly or wrongly, we've got a fall guy if they want one. Anne-Marie, thank you. AMH in New York, we like that. Anne-Marie, thanks for being with us. Thank you very much. BTIG's Isaac Boltanski expecting to see more doves seated on the Fed's board. He writes the following, quote, "One of the lines you hear most often in Washington is personnel is policy. This maxim is true across government, but especially so with the Federal Reserve, given its centrality in the global economy." With more, here's Mike McKee. Mike, we just got to wait.
We got to wait, although the reshaping of the Fed will be underway, and personnel is policy, and the Fed has one big problem. Let's talk about that. Let's assume, just for the start here, that they're only filling 3 seats because it's easier to talk about. Here are the qualifications that we will need. For a vice chairman, deep macroeconomics background and diversity. For a vice chairman in charge of supervision, a former regulator, maybe supervisor, or lawyer even, they need diversity. And then for the governor seat, diversity and diverse experience. You might notice one word keeps cropping up there. The Fed's problem is that they have only had 3 black governors in history and only 1 black bank president, Raphael Bostic, who's on many lists to move up to Washington. Blacks make up only 2 of the 417 economists at the Fed, the PhD economists, and that compares with 14% of America's population. So there's a lot of talk about who's going to get these seats, and I would be surprised if one of these people at least doesn't make it onto the board. The chair of the CEA, Cecilia Rouse, AFL-CIO Chief Economist William Spriggs, Lisa Cook from Michigan State University, and Seth Carpenter, he's Morgan Stanley's Chief Global Economist. We also may see women brought to the fore as they look for diversity. Sarah Bloom Raskin was a Fed governor, was Deputy Treasury Secretary, and is a former Maryland bank supervisor. She could fit the number 2 slot. Or Karen Dinan, who was the Treasury's chief economist for a while. So there are a lot of possibilities for the Fed, but you have to look in certain areas because this Fed needs to become less white and more diverse if it's going to meet Joe Biden's goals.
I think Morgan Stanley might have something to say about losing Seth Carpenter anytime soon. I'd like Seth just to stay here so we can keep talking to him, Mike, on a more regular basis, but I understand that he might want to go. I'm not saying anything for him. Mike, for me, for a lot of people, we need diversity, yes, point 1. Point 2, we need diversity of opinion. Raphael Bostic could be an interesting name here. Do you think they need some credibility on inflation? Because there's been a little bit more of a hawkish tilt from President Bostic in the last several months.
I would say a lot of that depends on the calendar. If they can get somebody through before we get too far into 2022 and the election year, they can go more dovish. Republicans' feelings don't really matter since Democrats control the Senate. If they can convince Joe Manchin that somebody is going to be good enough on inflation over the longer term, then they can do pretty much what they want. That's going to be the key vote there.
Mike McKee, we've got to wait. I keep saying we've got to wait, and I'm going to keep asking the same question of Anne-Marie every single morning. Where's the decision? Where's the decision? Mike McKee, Anne-Marie. Guys, thank you. Your equity market up about 0.1%. To break it down from a sector level, to lift the lid on the index. Here's our stocks editor, Dave Wilson. Hey, Dave.
Hey, John. You've got 8 of the 11 main industry groups in the S&P 500 higher. We're not talking, really substantial moves for any of them. Materials, the best performer, then industrials. You're talking about gains of 0.3% there. So not a whole lot of movement for sure. The standout in terms of declines, consumer discretionary. And don't forget, that's the category where you find automakers, home builders, retailers. Tesla weighing on that index now that we found out that Elon Musk sold even more stock this week, bringing his total to $5.7 billion. But what's interesting within the category, when you look beyond Tesla, well, you've got Rivian Automotive up for a 3rd day and now up more than 60% since its shares began trading. We're talking the world's 4th largest automaker, behind Tesla and Toyota and Volkswagen. I mean, bigger than Ford, bigger than General Motors, and you're seeing electric vehicle stocks as a group do relatively well here. Don't forget, this index set a record on Monday, and, it's hanging in, even though Tesla is certainly weighing on its performance today.
Dave, just a final word on that. You've been doing this a long, long time, decades. 112 billion for the market cap of Rivian. Can you think of a story similar to this? A story like Rivian, 112 billion market cap straight out of the gate.
Well, it's a hard one to figure out. I mean, even if you think about the big tech companies, over time, they built up to numbers like that, but they certainly didn't start there. I mean, it's clear that EVs are a real focus for investors at this point, and Rivian timed it right, you could argue, in terms of going public.
Dave, thank you. Dave Wilson, our stocks editor. They timed it better than right. They timed it almost perfectly. Coming up on this program, the market moving events you need to be watching. That'll be next in our trading diary from New York City this morning. Good morning. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
You talk about hiring aggressively at the moment. Can you walk me through how challenging that is at the moment? How difficult is it to find the right people?
Well, things have changed. Again, the world has changed under the pandemic, and you all know worldwide, you know what the challenge is with getting people back into the workforce.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
25 minutes into the session, equities advancing about 0.1%, a small bite out of a weekly loss of about 0.9%. If we finished right here, the biggest weekly loss going back to the start of October, no real drama considering where the drama was this week. A 6 handle on CPI in America. Does that change the story for your call for this bond market? Switch up the board and get to the bond market. 2s, 10s and 30s with a focus at the front end of the curve. Back through 50 basis points on 2s. More calls started to come through about bringing forward, pulling forward that first rate hike from the Federal Reserve. That will be the debate into next week, and helping out that debate, informing it, a bit of data. Here's your trading diary. Coming up at the top of the hour, the University of Michigan Consumer Sentiment Survey. Looking forward to that. Alongside it, jobs data. Then later, Fed President John Williams speaking at noon Eastern. Busy Tuesday next week with President Barkin, Bostic, Georgia and Daly all on the calendar. Plus, we'll get US retail sales for the month of October. A host of retailers reporting throughout the week, including results from Walmart and Target. And finally, initial jobless claims out on Thursday morning. From New York City, if I don't see you again, if you miss real yield, enjoy your weekend. And thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
Engine number one was able to do on the Exxon fight, it opened a lot of people's eyes to, I guess, the power that smaller investors can have. And I'm curious as to how other people can sort of look at what you did and use that is either a template or maybe just some sort of guide as to how they can sort of approach their relationships with other companies.
We founded the company in engine number one on the idea that we take the data, not ratings and rankings of ESG of the past, but we actually take the environmental, the climate, the social, worker data, and we simply use it to look at the valuation of companies and look at it over a long period of time. And so if you think about it that way, you own these companies. Everybody that owns the company, whether you're a big institutional investor or you're a small retail investor, you own the company. You have a voice, you have a vote every year.
Yeah.
And so our approach is to use the vote and engage with these companies over time.
But that's always been the case. I mean, at least in theory.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Will we get to herd immunity? Or let me ask it a different way. Have we given up on herd immunity as a practical matter?
You will know when you get to that point, when the cases are so low, they're barely detectable. That's what herd immunity means. We don't know what that percentage is, David.
Months after Hurricane Maria, Puerto Rico is still in peril. Huge swaths of the island are still without power, running water, or access to medical care. Experts estimate that it will take years before these services are restored island-wide. Much of the blame has been placed on FEMA for a slow response in comparison to recent disasters on the mainland. But recovery from a disaster of this complexity and scale has proven more challenging than anyone anticipated. And filling the gaps between an overextended public sector and a suffering populace falls on the private citizens. Robert Anderson is a Puerto Rico resident of 4 years.
The eye of the storm came in south of El Yunque, swept up towards San Juan, and out to Arecibo. Everything on the right-hand side is what we call the dirty side of the storm.
This isn't his first time in a disaster zone. With a military and telecom background, Anderson worked on repairing damaged cell phone towers in New Orleans after Hurricane Katrina. Some might be tempted to label him a disaster capitalist, seeking lucrative government contracts for his expertise. But as Anderson finds himself in the middle of a humanitarian crisis, he and his associates are developing a variety of pro bono recovery projects that target the island's hardest hit areas.
I see two Puerto Ricos. We're here in San Juan. They have telecommunications restored. They may or may not have power, but basic services are in place. They're able to get food. They're able to buy things. They're surviving. And when you look outside of the San Juan area, you can go 15 minutes from here and find areas that are devastated. I'm working on the devastated side.
Today, he's put together a boots-on-the-ground mission to provide medical care to some of the island's most isolated and vulnerable residents. Steve Berenbaum is one of Anderson's business associates. He offered an extra car and a set of hands.
So we received an initial report from a nurse that was out in the area. We're headed to the northeast region of Utuado for some people that are in need of urgent medical assistance.
Dr. Sally Priester is a physician from San Juan. She filled a van with medical supplies at her own expense and brought along a team of nurses. Google Maps estimated our first destination to be a 90-minute drive. But it didn't account for obstacles like this. Our first stop was the home of an 82-year-old blind Vietnam veteran. His roof was blown off by the storm, and he's been living alone in a back shed for nearly 2 months.
His cane actually got broken in the storm, so he's limited mobility. He has a number of medical ailments. Dr. Priester's having a look into him. We called the VA. They're going to get him set up with what he needs, get him stabilized so he can then be transported either to an evacuation center or off the island. It's when the chain gets broken, when those families that are connected to them leave the island or take off, these guys get left at the end of the road, and it's tough.
FEMA was not officially part of Robert's team, and their arrival caught everyone by surprise. Their job here was to survey and report back to their superiors, and did not come with medical aid of any kind.
People think that FEMA is there to hand out bottles of water, and it's not what they do. FEMA has a role to play. They have a very specific role. They bring in ships, they bring in airplanes, they bring in tractor trailers with pallets of things. But they're a big machine, and there's gaps in that thing. And you're seeing one of the gaps here, and we help fill that role. These guys are in a bad situation before, and now they're struggling for real basic things. One of the risks that you run is people going from fear to hopelessness. Those are the folks that we're trying to reach.
And how are they reached? How are they even found?
Word of mouth, mostly.
And what's your role in all this?
ghost in the machine. I'm lucky enough to be able to communicate with folks in FEMA, the state of Puerto Rico.
For a ghost, Robert makes his presence well known. Not only was he the de facto leader of the mission, now with FEMA in tow, he created his own maps to survey storm damage.
So we're right here.
And delivered them to FEMA HQ free of charge.
I have pretty good reach.
Perhaps that's how he managed to earn himself a coveted FEMA badge without actually working for them. And it's these relationships that allow him to operate more efficiently than an NGO or a government agency.
We're able to resolve problems at a different level.
Our next stop was on a mountaintop, a family of 11 struggling to care for their special needs brother in what was left of their house.
Probably we are the first health team to come and visit this family.
Muy bien, todo muy bien.
The patient has Down syndrome. He is all day in bed. The difficulty with this is the patient cannot be alone. The most important thing is that you need to take care of the chronic disease besides disability, because they have been not going to a doctor, and no doctor has come in here yet.
So we need a refill of this medication.
After maybe 54 days, it's not getting better. And the only way that you can be able to see that is coming to the ground, drive, and see the people and talk to the people.
You can see San Juan from here, but you can't get there. It's like the Emerald City.
On this stop, we caught word that a man living alone at the edge of the jungle was in need of care.
So we decided to take a little detour, come up here and check out and see what's going on. One of the challenges is to find those people that are at the end of these roads that need help.
¿Pero por qué estás solo? ¿Por qué estás por acá tan solo? I'm asking about why he's alone right here.
He said things of life happens. Yeah, I'm here by myself.
So ¿dónde vive acá? En la parte de...
This is not a job. To do this, you need to have passion for what you can do. You're not going to get paid.
It's said in disaster response and emergency response that the real first responders are your neighbors. You don't need to wait for a lucrative FEMA contract to go out and do good and to help the community.
In the end, do you feel like you're making a difference?
Lives you touch and people that you can affect. I don't really think about it in those terms.
But why do you do it?
It helps me sleep at night. I think it's as much for the people that are going out to help and do things as it is for the people that you affect.
Whether out of altruism, or the lure of a paid gig, or some mixture of the two, Anderson hopes to stay here to help shape Puerto Rico's future.
Puerto Rico's essentially been a colony for 400 years. It was treated poorly by the Spanish. It was not treated well by the United States when they first got here. Puerto Rico can continue in the way that it's always been, or Puerto Rico can rebuild itself like nothing that's ever been. And we have to do everything we can to make that real. That's the bottom line.
When I met him first online, I found him to be really sweet. I think I was the one who was talking for an hour. He was just listening.
When we met, I saw her. She was beautiful, intelligent, and kind, which was, something that I was looking for.
Anshu and Sumit are one of about 12 million couples that get married in India every year. Unlike their parents' generation, they're not from two close villages, but from two cities on opposite sides of the country. And their love didn't start through community matchmaking, marriage brokers, or classified ads in newspapers, but began online.
So we met through jeevansati.com. So it's basically an online portal where we have detailed profile of different grooms and brides.
It makes a lot of remote profiles who are located in distant areas more accessible.
Thanks to growing internet and smartphone usage, matrimony websites and apps in India are starting to disrupt the matchmaking industry. More and more people are finding their partners at the click of a mouse. Jeevansati.com, where Anshu and Sumit met, is one of the biggest players. Young Indians looking for love set up profiles including their caste and horoscope, but their criteria for choosing spouses appears to be changing.
We have seen the shift from, traditional caste community conservative parameters to something like which is more focused on education, employment.
Anshu and Sumit's marriage was initiated by their parents, but modern Indian couples like them have more input than previous generations.
We looked up to them to agree for the proposal, but it was primarily our decision that we wanted to be with each other.
So what's the emoji you'll use the most to send to each other?
There's a bear, which basically we use for indicating a hug.
Yeah, that's our language basically, bear icon for a hug.
Time flies when you're in love, and just 1.5 months after they first met online, the couple got engaged. They decided to hold their wedding less than 3 months later. But planning a traditional Hindu wedding on such short notice is no easy task. The massive event usually lasts 3 days, has various ceremonies and celebrations, and involves the entire two families and hundreds of guests. Luckily, there are websites and apps for that.
We searched online, we got in touch with Wedding Brigade, and they helped us finalize the venue. And it makes the search faster and efficient.
Startups like the Wedding Brigade are challenging traditional wedding planners in this $50 billion industry. It provides various services from booking banquet venues to buying wedding gowns. The website makes money by charging commission from vendors.
People don't want to be limited to what is available around them. They want to know the entire range of options available before making a decision. And now it's easy to find almost everything on one portal.
Anshu and Sumit are officially married in a ritual that has gone on for thousands of years, but their love started in a very new way. Technologies might be changing the way couples meet, date, and get married in India, but they're definitely not changing everything.
The technology was only the first level help that we could get to find each other. Everything else was like very humanly and emotions and feelings based.
Massachusetts Senator Elizabeth Warren has become a symbol of everything the Republican Party stands against.
Everyone gets a right to basic health care. We need strong oversight of these banks.
A legal scholar and a consumer advocate turned politician, Warren has branded herself as a champion of the working class and made a career out of standing up to big business. While rumors of a 2020 presidency bid remain just that,
I'm not running for president.
Her Senate seat is up for re-election in 2018, and Republicans are already pumping millions into super PACs to defeat her. This is the story of how a law professor and politician came to be seen as the biggest threat to Republican values and the greatest hope for progressive America. Elizabeth Warren was born Elizabeth Ann Herron, the youngest of 3 siblings, on June 22, 1949 in Oklahoma City to middle-class parents. After waiting tables to help her family pay the bills, Warren became a star on the high school debate team. She landed a scholarship to George Washington University at the age of 16, but 2 years later dropped out to marry her high school sweetheart, Jim Warren. By 1980, Warren was a mother of 2, divorced and remarried, had earned a bachelor's degree from the University of Houston, a juris degree from Rutgers, and practicing law in New Jersey. Warren then went on to become an influential law professor, teaching, lecturing, and publishing highly cited work on bankruptcy and commercial law at 7 universities around the country, eventually settling at Harvard Law School. But Warren wasn't always a liberal lion.
Elizabeth Warren used to be a Republican, actually.
That's Stephen Dennis.
I'm a Senate reporter for Bloomberg. Around the time that Elizabeth Warren switched parties, she became a fierce opponent of a Republican drive to make it much harder to file for bankruptcy. She fought that for a decade. It ended up passing anyways.
While her efforts ultimately failed, her warning calls were heard in 2008.
We're in the midst of a serious financial crisis. Our entire economy is in danger, and without immediate action by Congress, America could slip into a financial panic, and a distressing scenario would unfold.
Professor Warren was tapped to help with oversight in the government bailout.
She would excoriate bankers and their bonuses and their practices.
Why should the U.S. taxpayer alone carry Citi?
She proposed a series of tough regulations, which became the basis for much of the Dodd-Frank financial law that we have today. That sort of catapulted her to national stardom, particularly among the progressive left.
Encouraged by her newfound notoriety, Warren declared her bid for the U.S. Senate on September 14, 2011. During the race, her opponent Scott Brown tried to derail Warren by accusing her of falsely claiming Native American heritage, a controversy that earned her the nickname Pocahontas. Nevertheless, she was victorious and won the Senate seat by a comfortable margin. She used her new tenure to challenge everyone, from banking regulators and Treasury officials to members of Wall Street and Congress.
I'm really concerned that too big to fail has become too big for trial. We need tough new laws to hold corporate executives personally accountable. No one should be above the law.
She called for Wells Fargo CEO John Stump to resign for fraud, introduced the Bank on Student Loans Fairness Act, and reintroduced the 21st Century Glass-Steagall Act. In 2016, after staying silent during the Democratic primary battle, Warren finally endorsed Hillary Clinton and had some harsh words for candidate Trump.
Donald Trump is a loud, nasty, thin-skinned fraud who has never risked anything for anyone, and that is just one of the many reasons he will never be president of the United States.
But she was wrong.
The forgotten men and women of our country will be forgotten no longer.
Warren wasted no time resisting Trump's agenda.
Have you ever managed or overseen a $1 trillion loan program?
I have not.
How about a $1 billion loan program?
I have not.
Okay.
In the Donald Trump era, Elizabeth Warren has been playing defense and trying to prevent Donald Trump and his cabinet appointees from rolling back protections that she helped enact.
Warren actually found herself rebuked by Mitch McConnell for reading a letter by Coretta Scott King about Jeff Sessions' record on racism during his confirmation.
She was warned. She was given an explanation. Nevertheless, she persisted.
That moment became something that's on T-shirts, bumper stickers, slogans, and that really galvanized a lot of support for her. It's been very hard for Republicans to get much of anything done this year, and that's at least in part to this resistance movement that Elizabeth Warren has helped champion.
We are here to fight back.
Enough of Elizabeth Warren. Like you,
millions of dollars are being funneled to defeat Warren in the midterm elections in 2018. But it's the rumors of a 2020 presidential bid that has further prompted powerful donors to fund her opposition, often using the same playbook of constant and ruthless ad campaigns that many believe helped Trump win in 2016. It's anyone's guess if she will endure what Hillary could not.
You know, the question for Elizabeth Warren is whether she can go from being a liberal firebrand to somebody who can regularly get 60 votes for initiatives in the Senate and 218 in the House and drive an agenda, and whether she can bring together coalitions for political victories. That's the challenge, and we'll see what happens.